This isn't a thing where it's going to be a long-term shutdown.
Trump is playing a different game by a different set of rules than I think the Democrats on Capitol Hill.
The market doesn't seem to really be paying attention to what's happening from, the government shutdown perspective. The data is the data, whether it comes out or not.
This means we're flying blind in a highly foggy environment, and this is very risky.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday, shaking off the politics. Equity markets kicking off October, adding to September's rally as Washington shows little sign of delivering a breakthrough. The limited data we do have is keeping the Fed well on track to cut interest rates.
And look, yesterday's ADP data is controversial, especially with some of the revisions. But what's fascinating to me is how the economic data, the limited that we have, is being interpreted completely differently in the bond market or the stock market. The bond market is saying, oh no, weakness ahead, the Fed's got to cut. The stock market is saying, yay, the Fed is going to cut, risk on. And how much does this reflect two different economies in parallel that the Fed is responding to in one hand and the stock market's responding to in another hand?
Now, typically we'd say, wait for the data, jobless claims, payrolls, to see if it confirms what we got from ADP, but you're going to have to wait a little bit longer. No claims later on this morning. Perhaps no payrolls tomorrow morning at 8:30 Eastern time.
It doesn't look like we're going to get the payrolls report tomorrow. We do not have right now a working framework for Democrats to be willing enough to sign up for the continuing resolution to keep the government open. And I say that because Senate Majority Leader John Thune had this interview with Politico and almost acknowledged that there has been outreach between these two groups and that they would be willing to have a conversation when it comes to health care and these subsidies when they have 8 or 10, preferably 10 or more, Democrats sign up, base a little bit more mass, that they're willing to have a negotiation if more Democrats are willing to keep the government open through this continuing resolution.
Typically, investors don't really care about it. The market looks through it. The economy bounces back. Timing matters. Is it different this time? Neil Dutta, Renmac, had this to say. It's coming at a fragile time. It could go on for a while. Government workers might save more if they think this will happen again. He's a little bit more nervous about the position we're in, the timing this comes at, and what could happen to this economy.
And that's from the economic perspective, and that's without the potential job cuts that we hear being threatened from the White House that could come in the next few days. There's an additional aspect, which is this is a highly confusing moment economically with even less data. We're in a dark room, and now we've got blindfolds on, and now we've got big helmets over those blindfolds. And there's a question here, especially as Austin Goolsbee of the Chicago Fed comes out. Think what you will of some of his proclamations. He said this just makes it incredibly difficult for us to really have up-to-date information as we head into that meeting, as it's unlikely they're going to be able to get CPI the longer this drags on.
So you've got the data, and then Brammer pointed out you've got the equity market close to all-time highs, at record highs, and then you've got private markets too. Valuations. Do you remember the definition of a unicorn? Private startup, valuation of $1 billion. We've got herds of them now. Check this out. $500 billion valuation for Open AI. Just get your head around that. A few years ago, unicorn, super rare. $500 billion valuation for that company.
Yeah, now we're selling My Little Ponies. Look, I'm looking at this and I'm thinking to myself, at what point does this indicate froth? And at what point does this represent the sea change that OpenAI really represented, that catapulted a lot of the tech valuation from 2022 and completely transformed the way that AI was viewed in terms of its potential in this economy? So one of two ways of looking at this is a Rorschach test, as people kind of game out valuations of other companies as well.
Nasdaq futures up this morning, on the S&P as well, high by 0.2%. Coming up this hour, John Stoltzfus of Oppenheimer as markets struck off the government shutdown, Vito Sperduto of RBC Capital Markets on a surge in deal making, and Kelsey Berro of JP Morgan Asset Management on what labour market weakness means for the Federal Reserve. We begin this hour with stocks rising after closing at record highs. John Stoltzfus of Oppenheimer calling for a street high 7,100 on the S&P by year end, writing this: economic resilience along with revenue, earnings growth and innovation across the sectors remains key in our view to the market's ability to continue climbing the proverbial wall of worry. John joins us now for more. John, good morning.
Good morning.
Is that government shutdown just another brick in that wall of worry?
I think it's another brick in the wall, to quote Pink Floyd. And that said, we've seen the markets really overcome and traverse hurdles all along this year. And it is indeed, it's the innovation, it's the resilience, and it's a different structure in terms of the market itself, we believe, in terms of participants. You know, the market is not just the guy with the monocle from the Monopoly game, you know. It's all kinds of people. And in the U.S., it's multi-generational people investing for longer-term goals. So the disturbances that are caused by the potential for a short-term or intermediate or longer-term shutdown are of less concern to them right away, as opposed to getting money positioned for goals that may be 3, 5, 7 years out.
Can I build on that, John? Do you think there's some tension between different generations on how they view how this market should be valued? Some tension between the boomers and what they think the appropriate multiple is for this stock market with a different sector mix?
Most certainly. I think, when you look at people who've been, the boomer generation, stocks are cheap at a 16 forward multiple. As you go forward in generationally, people are willing to pay higher multiples for growth. And I believe the reason why, a lot of it comes from Ed Yardeni, who's for years said that the Wilshire 5000, there aren't enough stocks to really qualify that are publicly traded anymore for that indices anymore, because it's, about 3,500 stocks or 3,400 that you actually have to choose from. And the thought is here it's supply and demand. It's the basic thing of economics. The demand for your technology, your hyper growers, the ones who are well established, deeply embedded in the lives of both business and the consumer, where we're all on the upgrade cycle, whether we like it or not, as I always like to say. This is what's driving this market in many ways, and it differentiates, not just generationally, but the difference between traders who are looking at risk to capital, capital put at risk on a day-to-day, minute-to-minute basis, and intermediate to longer-term investors. When I started in this business 42 years ago, hard to believe. It's not that I didn't think I'd live this long. I didn't know how long it would happen. But it was the retail investor would always come into the market, usually once the market was up 20% and everybody knew it, and the cab driver was asking you for a hot tip if he saw you had a copy of the Wall Street Journal under your arm. Today, people are very well informed by the financial media. They have all the arguments. You get to see the players actually express themselves, and you see the body language that people are using, and it makes it's remarkably more intimate than it was ever before, and people are better informed and better able to work, we'd like to think, with financial advisors who are working as fiduciaries.
They also are better sold on the story of the hopes and dreams of just how much AI can do. And there is a lot of truth to it. And history doesn't repeat, but it does rhyme. And back in the dot-com bubble, boom and bust, there was AOL. You've got mail. We don't do that anymore. I mean, some people still do, and God bless you. But I'm just wondering, going forward, how do you identify all of the money that's going to be wasted at a time when there's a lot of projections and not a lot of data on what ultimately will happen or how it's going to be applied? Well,
I think for one is if we just go back to as recently as the tech bubble, things were practically primitive versus where we are today. I can remember working at another well-known firm headquarters on Broadway in 1997, and suddenly you would find the internet would go out, and when you would go home to connect to the corporate, you'd have, some kind of little device would be and all that stuff. Today, we still have problems with technology, but it's very well established. And the idea is, I can remember putting dimes in a payphone. People don't even know what a payphone used to look like. Sometimes I see an old architecture in our building, which another firm had before us. There's actually a group of things, no phone anymore, but what are these things for? They're for the press as they exited to write things down. But where we are today, I think a lot of the stuff will likely prove disappointing, but the core will be, it's already being invested in and utilized to create greater efficiencies.
I guess that you talk about the babies being thrown out with the bathwater. I don't see any babies, and I don't see any bathwater being thrown out either. Nothing's being thrown out. So how do you identify what that means?
Well, I'd say actually on a day-to-day basis, I'm not solely a strategist. I also manage money for the firm, both an ETF portfolio with passive indices and then individual stock portfolio. And we've seen a considerable broadening of the rally that has suddenly rewarded sectors like industrials. We've seen better attention played to utilities, both on, as it looks like the Fed is going to be cutting rates going forward, not necessarily enthusiastically, but on a down payment kind of basis to show that the rate hike cycle is over. What you have effectively is you've got utilities are no longer considered as much of a risk as a bond proxy, because it looks like interest rates are coming down. Healthcare has caught a bid as a result of one company's efforts to reduce prices in the last couple of days. I'd mention the name of the company, but because I manage money, the firm doesn't let me. They don't want me pitching stocks that I might or might not own.
Staying on the Fed, how difficult is the end of October's meeting going to be if this government shutdown is prolonged? We know we're not likely going to get tomorrow's payrolls report, but then what about CPI on October 15th as well? They might not have all the most relevant, up-to-date data. I
think, I think it's close enough to the September meeting that I think we kind of got a fairly good idea that the dot plots showed that there would likely be a cut in October. And I think we're close enough in terms of the data. I think the question would be to December, what's going to happen there. And hopefully by then this will be behind us, this whole question of the shutdown.
John, never mind the bathwater. This has been a pool party now for 6 months. And it's getting wilder. I think spring break. Don't want to go there. Okay. Look at the valuations we're seeing in private markets. $500 billion on a startup. Now, John, I'm just trying to work out, never mind the risk aversion. I don't see any. I saw a bunch of debt issuance in September and people starting to get pretty excited about the future still on top of that. When do you start to get concerned?
Well, I play in the public markets as opposed to the private markets.
Doesn't one inform the other right now?
I think to some extent, but the selectivity there and what is chosen to move into the private equity market is not necessarily everything at play. I think that's something to look at as we go forward. And that, as you mentioned, the money that's being thrown at this one particular deal is like, the valuation is rather worrisome, except if you consider how much is already developed. This is this isn't the primitive stage of people saying, someday we will have 1 million eyeballs on our website.
Sure.
This is companies that know you need billions of eyeballs. And you need to be well capitalized, and it's not just well capitalized, but the likelihood of cash flow generation pretty quickly from here to there. Because this week I was at a due diligence meeting at an ETF firm, a management firm that has ETFs,
right.
And their technology people just talking about all the investment that's being made here, but by smart people who are educated and deeply involved in tech for maybe 40 or 50 years.
John, it's good to see you. Always is to get your thoughts. An experience spanning 40 years plus. John Stoltzfus there of Oppenheimer. Fascinating story just dropping from Reuters. Check this out, the lead paragraph. Eli Lilly was asked to produce more insulin. Pfizer to produce more of its top-selling cancer drug, Ibrance, and its cholesterol drug, Lipitor. And London-based AstraZeneca asked to consider a new headquarters in the US, according to two news sources. This dance between the US and the private sector. Trump seeking deals in 20 to 30 critical industries before the midterms. The White House and agency staff are seeking deals that can be announced by the president. Deals include taking equity stakes and regulatory relief in exchange for concessions. That dance has been a dominant feature of this story for the past 6 months.
Sounds like Trump RX wants to expand. Further in the story, they talk about how these executives are getting near daily calls from Chief of Staff Susie Wiles, and it comes at a point where during the shutdown, the debate that Democrats want to have is around health care. And this is something that Democrats actually, one of the few areas right now they are polling better than Republicans. So if Trump can make this a Republican issue that we are delivering, maybe on bringing drug prices down, at least seeing that they are in active engagement with some of these pharmaceutical companies, that could be a political win for them going into the midterms.
That's the latest story from the team over at Reuters this morning. Let's get you an update on stories worldwide elsewhere with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. The White House is preparing for mass layoffs of federal workers as the U.S. government shutdown stretches on. Budget Director Russell Vought told lawmakers that agencies will move to terminate workers within 1 to 2 days, according to people familiar. Details about what agencies or positions would be targeted remain unknown. The U.S. Supreme Court refused to allow President Donald Trump to immediately oust Federal Reserve Governor Lisa Cook as she sues to keep her job. The court's order means Cook can remain in her position at least until January, when the justices will issue a new ruling after hearing arguments over her alleged mortgage fraud. OpenAI's valuation soars to $500 billion. That makes it the world's most valuable startup. Sources telling us here at Bloomberg, current and former employees sold more than $6 billion worth of stock, pushing the company past its previous $300 billion valuation. This all as negotiations are underway with Microsoft to convert OpenAI into a for-profit company. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, bracing for layoffs.
If this thing drags on for another few days or, God forbid, another few weeks, we are going to have to lay people off. I actually don't think it's going to be that long of a shutdown. You already saw some evidence that moderate Democrats are cracking a little bit.
That's up next with Michael Townsend of Schwab, live from New York City this morning. Good morning. Typically, given it's Thursday, we'd be about 2 hours away from jobless claims. Not getting jobless claims today. On to tomorrow. Looking for payrolls, 8:30 Eastern Time. Probably not getting payrolls at 8:30 Eastern Time. So your big event tomorrow could be the ISM services at 10 a.m. Eastern Time tomorrow morning. Now, typically, sometimes that does end up being the bigger event on payrolls Friday. ISM services, big chunk of the economy, important read for the month of September. I'll be glued into that one. Never mind payrolls.
Yeah, that's why I was really excited yesterday for ISM manufacturing, and then it came out and it was just sort of meh. It kind of doesn't give us any clear sense of where things are going. Same with some of the other data that we got ahead of what was supposed to be jobless Thursday and then potentially non-farm payrolls on Friday. I am curious, though, to see whether you are seeing any acceleration or any clarity and how much that could inform what the Fed ends up doing.
The data we have got, ADP, the lowest number since March 2023. Lisa talked about factory activity shrinking for a 7th consecutive month. New orders slipping back into contraction. That was slightly unnerving yesterday. That was bad news, and that was good news for the bond market, and apparently good news for stocks too. Equity futures up again this morning by 0.2% on the S&P, and the Nasdaq up by 0.3. Under surveillance this morning, bracing for layoffs.
If this thing drags on for another few days or, God forbid, another few weeks, we are going to have to lay people off. We're going to have to save money in some places so that essential services don't get turned off in other places. That is the reality of the government shutdown that Chuck Schumer and the Democrats have foisted upon the administration. I actually don't think it's going to be that long of a shutdown because I think you already saw some evidence that moderate Democrats are cracking a little bit.
That was the Vice President of the United States on the government shutdown. Here's the latest so far this morning. The White House and the Budget Office warning the administration will begin firing federal employees due to the government shutdown. Bloomberg's Laura Davison joins us now from Washington for more. Laura, welcome to the programme. Walk us through the next stages of this. What happens today, tomorrow, through the weekend?
So as soon as today, we could start seeing some of these mass layoffs that Russ Vought, who's the budget director at the White House, has teased. He is playing very hardball tactics here and is playing a politically astute game. He's not just cutting random spending or looking to cut random jobs. He's looking to cut the government where it most affects Democrats, particularly key Democrats in this fight. So we saw yesterday one of his first moves was to cut infrastructure funding, about $18 billion for New York City. Of course, Hakeem Jeffries, the Democratic House leader, and Chuck Schumer, the Democratic Senate leader, are both from New York. We then saw he cut green funding from only states who voted for Harris. As we move into this job phase, which again could start as soon as today, it's likely that these jobs will be either for programs that Democrats like or in places where Democrats live.
Laura Davison with the latest down in Washington, D.C. Laura, thank you. Michael Townsend of Schwab joins us now for more. Michael, welcome. I just want to build on some of that with you. What you're looking at the moment and ultimately who's benefiting from any of this in the court of public opinion. Is anyone winning?
Yeah, I think it's really hard to see anyone winning at this point. And, I think the administration is trying these kind of hardball tactics that target Democrats. And I think the question is whether that actually hardens the Democrat position rather than, sort of making them cave. The vice president in the quote you played, referenced that there has been a couple of Democrats that have voted for the most recent iteration of the temporary extension of funding. But it's only been a couple, and they still need several more. From the Republican perspective, they need at least 5 more Democrats to get on board. I'm not sure that these tactics are the way that's going to happen. So I think this is going to play out over a longer time than maybe the vice president thinks.
So when OMB Director Russ Vought, though, gets on a call with House Republicans and says we're going to have these mass reductions in the workforce, firings are going to begin, is that going to be legal when the government reopens?
Yeah, I think this is an interesting question about whether it is legal, because typically, as we've gone through shutdowns in the past, right, workers are furloughed, and then they get their jobs back when the government reopens, and in most cases, they're retroactively paid for that time. So, I think this is like so many things in the administration. It's likely to end up in the courts, and the decision on whether it's legal or not is going to play out in real time, and then possibly after whatever happens with the end of the shutdown. So I think that's an open question.
This is one tool the Republicans are using to try to make this as uncomfortable as possible for the Democrats. We also saw, obviously, the freezing of funds when it comes to blue states, like what's happening here in New York. What else can the Republicans do?
Well, I think, first of all, though, it's important to remember that you can't target just Democratic voters, right, on this. I mean, if you're laying off federal employees, there are plenty of federal employees who live in Republican districts, who are Republicans, who voted for the president, who are probably going to be frustrated. So I think that's the first point, is that, you can be as targeted as you want, but you're still going to end up affecting a wide swath of voters than maybe your own voters. And so I think, how the public and the voting public feels about this is going to be something that's really, really important to watch over the next week or two as this plays out. But I think you're going to continue to see the administration, target programs and areas that are predominantly Democrats. They're going to try to target Democrat priorities to make this more difficult for Democrats. But I think the flip side of that is, do you end up in a situation where you're sort of hardening the Democratic position because it becomes so transparently political, what the administration is doing? So, the dynamics of a government shutdown are always really, really strange. I think this is going to be one of the stranger ones, and we're just going to have to see how it plays out.
Sort of like some of the imagery coming out of the Oval Office yesterday with President Trump and the Democratic leaders that sent a pretty strong message. I guess my question is, you said that some of the hardball tactics could harden the Democratic views. I'm just wondering if you believe that this shutdown could go on a lot longer than markets are currently pricing in and have a greater ramification for the economy.
Yeah, I think there's a possibility. I'm sort of the view that either this gets resolved relatively soon, like, say, sometime next week, or it extends for quite a while, and perhaps, through the month of October. And I think that's going to really depend on where Democrats feel like they can come out victorious in this. This whole battle over the expiring enhanced subsidies for purchasing health insurance through the Affordable Care Act, that's something that there are Republicans that are in support of, and particularly in the Senate, where I think there are Democrats and Republicans talking behind the scenes about ways to get that done. The question is whether, even if you got some kind of deal in the Senate, could that pass the House, where I think conservatives are much more hardline against those. So I think there are a lot of machinations that are going on behind the scenes. Right now, those don't appear to involve leadership very much. But, as shutdowns drag on and the public gets more and more frustrated, maybe you can get to some kind of deal in a relatively short term. But I do think there's a decent possibility that this could last for multiple weeks.
Michael, thank you, sir. Michael Townsend there of Charles Schwab. That's not where this market is. I don't think it's where many people are. Peter Chi of Academy said the same thing yesterday in a note. He said, I wouldn't be surprised if this one lasts weeks or even months and not days.
It really is informed by what happened in March when Chuck Schumer allowed the government to stay open and cut a deal with the Republicans. And then it came under scathing criticism for having folded, not doing enough. And so you start wondering, what is, to your question, the idea of the political blowback? How much is there? And right now, it's unclear. Nobody's particularly happy. You point out airlines. I think that you're right.
Well, if it's prolonged, curmudgeon travelers is what's going to do it. When you had the 35-day shutdown, Trump's first administration, the same day the FAA started closing and talking about delays in some of major airports is the same day Trump agreed to a temporary government funding measure.
Most people I know are curmudgeon travelers.
Everyone's a curmudgeon.
And this is going to make it that much worse.
Coming up on the program, Vito Sperduto of RBC Capital Markets on a big year for deal making. Four-day winning streak on the S&P 500, the longest daily run in around about 3 weeks. This morning we add to it, up about 0.2% on the S&P, up around 1/3% on the Nasdaq, up by 0.4 on the Russell. Lisa talked about yesterday's bad news being good news for this bond market across the curve, particularly at the front end, the return of the so-called bull steepener. 2-year yields down, a decent chunk. We're back down to the 350s. And this move for gold. What a move for gold. Precious metals taking off this year. We're talking about something like a 50% move year to date. Goldman Sachs, good friend of this program, Dan Struyven, said this in a note. The potential for private investors to diversify significantly into gold presents a large upside risk to a forecast of 4K for mid-26 and 4,300 for the end of next year.
Well, in fairness, we've gotten to almost 4K this year, potentially even at the end of this month. I mean, we've talked about the biggest month of gains for gold going back to 2011 in the month of September. You start wondering why? Well, it's exactly the dynamic you were talking about. The front end of the yield curve is responding to a labor market. The equity market and risk assets are responding to something completely different. You put the two together, and it seems like this economy is going to be run hot. It's going to lead to some marginal increase in inflation, and that's going to debase on the margins the dollar even further.
Getting closer and closer to 4K on gold, up again this morning by 0.4%. 3 hours away from the open and bell. Let's get you some single names, some morning movers. Here's Vonnie Quinn with more. Hey, Vonnie.
Hey, John. Yep, I thought I'd start with Tesla because we are waiting for third quarter delivery numbers out this morning. Investors are hoping to be pleasantly surprised, looking for just under 440,000 deliveries, in fact. Now, as we know, the stock has been languishing for part of this year, but since Elon Musk renewed his focus on the company, we have seen a nice run-up. And again, shares pre-market up 1.5%. If we do get something around the 440,000 mark, that would still be a 5% decline year over year and a third straight quarter of declines. But it would mean that the company was doing better than the first half of the year, where we saw sales down 13%. So next up, I want to take a look at Equifax. This is a really interesting one. Shares plummeting this morning. It might be getting disintermediated to some extent from the Fair Isaac Corporation. So FICO saying late yesterday that it's going to start giving mortgage lenders the option to calculate and distribute FICO scores directly to consumers. Now that's a threat to companies like Equifax, also TransUnion and Experian, the three big credit reporting firms, and we're seeing the halo effect across the industry this morning. So we'll see if those companies can try to change how they do their business, change their business model to some extent to meet this threat from FICO. Fair Isaac, I should mention, is higher pre-market. And then Fermi, this is a fascinating one. This company was just founded in January, but by former Energy Secretary Rick Perry. It's an energy REIT, and obviously it's aiming to get in on the AI energy story. It's developing energy campuses. It already has 5,000 acres of land leased from Texas Tech. And just to let you know, it also refers to itself as the Donald J. Trump Advanced Energy and Intelligence Campus. So the story with this is it IPO'd yesterday at $21, opened at $25, closed the session up 55% at just over $32 a share. You can see where it's trading at pre-market. It also starts trading in London today. And this all values the market value of this company at more than $19 billion. Not bad for a 10-month-old startup, right, John?
Not bad at all. Not bad at all. We'll have more on that kind of thing in just a moment. Vonnie, thank you. Thank you very much. On a radar this morning, delaying the data, the Labour Department confirming the weekly jobless claims will not be released as scheduled today. This also puts Friday's crucial payroll report in serious doubt as the government shutdown continues. Elsewhere, the Supreme Court refusing President Donald Trump's bid to immediately remove Federal Reserve Governor Lisa Cook, the order allowing Cook to keep her seat until the justices hear her case in January. And finally, OpenAI is now the world's most valuable startup after employees selling about $6.6 billion in stock. That move pushing OpenAI's valuation to $500 billion, propelling the ChatGPT owner past Elon Musk's SpaceX.
I love what you were talking about before, that we used to look at who's the next unicorn at $1 billion. And now I'm thinking about this sort of flock of unicorns where there's like squirrels trying to get rid of them. I mean, at a certain point, you're wondering, at what point does this indicate froth? And at what point is this worthy, given the fact that ChatGPT single-handedly changed the conversation around AI and single-handedly changed the investment structure of a lot of these big tech giants and single-handedly changed the concept of what search was on the internet and is raising questions about the future of internet as we knew it. So on one hand, oh my gosh, froth, bubble. On the other hand, well, it's kind of a transformative moment.
But it does feel kind of like a bubble when earlier this year, this valuation was at $300 billion, and now we're October and it's $500 billion. It's pretty incredible, but also comes at a time when people are saying this might be the right strategy if you don't want to go for an IPO, because it's a way to make sure you're also retaining top talent. because they are getting some of this money back, and you want to retain some of your best when you have the likes of Meta pulling out, what, $1 million contracts?
Do you remember Long Island iced tea? We talked about this just last week. Remember when they renamed themselves?
I remember for lots of reasons.
Put blockchain
Carry on, John.
on the end? Do you remember
Lisa.
that?
Yes, I do.
Do you remember that?
I do.
They put blockchain on the end of the name, and there was this big rally for those kind of stocks. I remember having that conversation at the time, and someone correctly pointed out to me, don't allow that, the craziness, to distract you from the real things that are going on. And my response to some of that is don't allow the real things that are going on to validate and justify some of the crazy stuff happening elsewhere. And I think you've got to draw a distinction at the moment between both.
Part of the problem is this is sort of a science fiction moment, so people don't know what to believe. I'm just thinking back to the Long Island iced tea blockchain and thinking about Overstock, a furniture company, a furniture reseller that put blockchain in its name, that said the word blockchain, and suddenly it was, oh my God, the furniture is going to be on blockchain. At a certain point, you are absolutely correct. I think a lot of people are suspending belief because they don't understand the parameters of what kind of sea change we're in.
Some real things going on, particularly over at OpenAI. What a valuation. Elsewhere, the AI-fueled frenzy in capital markets driving record valuations and sparking a wave of deals. Investors weighing whether the M&A sprint will sustain its pace. Joining us now to discuss, the head of RBC Capital Markets US, Vito Sperduto. Vito, good morning. It's good to see you, sir.
Great to see you, Jonathan.
Thanks for being here, buddy. 6 months today since Liberation Day. I don't know where the time has gone. Can you describe what it was like then and compare capital market activity now?
It's been 3 quarters of what feels like 3 years, to be honest. So I think at the beginning of the year, one of the things we published was we said that we expected that everybody came into the year with a lot of euphoria, expecting significant deal flow, very much of a significant upside, less regulation. And we always said, well, calm down. First Trump administration, it took about 12 months to get to a place where everybody was comfortable and kind of knew how to manage in that environment. We thought that it was going to take about 6 months this year, not a full 12 months, and certainly that played out. And if you look at the different quarters, up until Liberation Day and just right after it, there was some concern. But if you look at the volume of transactions, so right now we sit about up 28 to 30%, whether you're looking at the US or globally in terms of announced M&A volumes. It's all being driven by larger transactions that are up somewhere between 50 and 65%. Again, depending on whether you look in the US or globally. What's interesting is the 3 summer months, June, July, and August, were each in total up 55%. So you just saw a sprint to the races starting in June, and it's continued into September. I think we were talking about whether the rate cut was going to drive more M&A, and my response was always, well, it's already happening. I'm not sure that we're thinking about that. And obviously the news this week, there's the question of does this shutdown impact things? And, again, I think there's still a good amount of activity.
Do you consider this activity just the consequence of pent-up demand, old ideas that have been delayed, or are these new ideas? Is this new business? Is this the start of things to come?
Well, I think it is a lot of pent-up demand. I think we came into the year with the conditions being very positive for the markets, very positive from a transaction perspective. And there were some self-inflicted wounds in terms of we had to get through some of what the government's trying to do on different policy. And I think now that the companies are feeling more comfortable with where they are and, feeling more confident and aligned between, say, the C-suite and the boards so that they can actually make decisions, they're going back and reevaluating transactions they've considered for some time. And so I would tell you, when you're seeing some of these large announcements that have been happening, those are transactions that have been considered for some time. It's not, just waking up one day and going, well, the next week I'm going to go and acquire this business. It's really, okay, we've looked at it before. Now let's reevaluate in the current conditions. Our board is very educated on this potential opportunity because we've kept them up to date. They're fully informed on the opportunity. But let's update it to today's conditions. Oh, now it aligns and makes sense. So now let's figure out how to finance it, how to structure it, how to make it work in this regulatory environment. Oh, the regulators are allowing larger opportunities. How do we position for that?
Do you like the idea that more of it comes in debt in terms of the financing?
I'm not sure if I would say more of it comes in debt. I would say that it's structured to what the appetite of the market is.
Which is debt.
It is debt, but I also think that, look, I've been at this for over 3 decades. I've seen when the debt component was even much larger than it is today. and then it pulls back to what's more reasonable. I think corporates are much better prepared today than they were, say, when we were in the global financial crisis or 10 years ago, because they understood what happened when their balance sheets weren't as nimble. And so I think they have more cash on their balance sheets. They're able to borrow at better rates. And even with the rates being higher than they were, say, it's still a situation where they're at all-time levels in many cases.
I wonder how much of the M&A activity is being driven by the idea that big companies have benefit right now. They are better able to be resilient in the face of supply shocks. They're better able to negotiate deals. They're better able to potentially get economies of scale. It seems like there is an emphasis on that now in a way that's different than, say, even 10 or 20 years ago. How much is that driving some of this?
Well, I think the key word you said is resilience. I think they're better able to manage their businesses, adapt quickly to external conditions. And so when they're faced with something that they haven't faced before, I mean, look, 5 years ago we went through COVID. And so we went through something that had never happened before. Businesses shut down for a period of time. They weren't able to do business. They had to quickly adapt. They've learned now they need to be able to plan for various forward-looking markets and businesses and be able to be prepared depending on what's thrown at them. And so I look at the large corporates, they're probably best positioned in that than they've ever been in the time I've been in this business. And so as a result, you're able to make decisions quicker. You're able to move when windows open. I mean, right now we're telling clients that the remainder of this year and into the first half of next year, we feel pretty good about the market conditions in terms of driving activity. And when I look at it, it's the things that could derail it are some of the external noise, and do you stop and listen to that noise, right? The shutdown this week, if it gets cleared quickly, it'll be a blip, right? Even the shutdown in 2018, 2019, yes, markets came down. They came back and went even higher afterwards. And so I think businesses are prepared to get through it. Now, if we go through a longer period and all of a sudden we get through the end of October and the Fed is making decisions blind without data that they would normally look to, and does that cause companies and boards to say, oh, let's take a pause and wait on this decision? And I think that's the other key thing I see is business and activity is not going away. It's more of a pause. So it's kind of moving to the right. And so, Jonathan, when you say pent-up demand, it's like, well, I've just been waiting to execute on that transaction. I haven't put it on the shelf.
So could the shutdown work as a catalyst, potentially, the way the April 2nd Liberation Day worked in terms of having businesses hit pause?
I think it could a little bit. Again, it'll depend on what we see going forward. Right now, it looks like, I was talking to one of my favorite analysts, Lori Calvasina, last night, and I asked her about Polymarkets. I said, has Polymarket made a market yet on how long this shutdown's going to be? And I think the leader in the clubhouse right now is October 15th or later, which is kind of interesting. And so she, very nicely pinged me about that last night. I think that, look, I worry about it being too long. I do get concerned in one way about the shutdown, which is it does hurt the IPO market. And so if I think about transactions, oftentimes you want, if you're selling something and you're able to go public, that's a viable competitive alternative that you want to hold out there. And so having less alternatives makes it a more difficult market to execute.
Can we spread the love a little bit, Laurie, Francis, Amy, just so people don't get jealous over RBC?
I spend a ton of time with Francis and Amy and Laurie.
You're doing great.
And it's all good.
Yeah.
You're out of trouble now.
There's only so many I can throw out.
There's so many different favourites. Vito, thank you. You're one of ours. Favourites. Thank you, sir. Appreciate it. Vito Sperduto there of RBC Capital Markets. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The European Union is planning to boost tariffs on steel imports. The European Commission will propose a long-term mechanism to reduce existing quotas for foreign steel and impose a new tariff rate on imports beyond those quotas. The EU steel industry has faced a severe crisis due to cheap imports from Asia and increased tariffs imposed by the US. President Trump says he will meet with Chinese President Xi at the end of the month for discussions on trade. Trump posted on social media saying that soybeans will be a major topic of discussion, with the crop remaining a key sticking point. China hasn't bought any soybean cargo from the current harvest, instead relying on Argentina and Brazil as retaliation for Trump's tariffs. Two Delta Airlines regional jets reportedly collided at low speed while taxiing at New York's LaGuardia Airport on Wednesday night. According to an ABC affiliate, no injuries have been reported. This is the latest in a string of incidents at LaGuardia in recent months that have prompted federal safety probes. And that is your Bloomberg Brief. John?
Nope. Vonnie, thank you. So your face too. Don't want anything to do with that stuff.
I was just thinking about the curmudgeons, the traveling curmudgeons. I mean, that just sort of adds to that joy that you feel when you get into it.
Every time there's an airline story, it's never a good one.
Well, but the truth is, we're publicizing more of them now. They happen all the time. I don't know if that should be comforting or not so much, but, you know, yeah, not
I'm not taking much comfort in any of it. Okay, up next on the program, signals and the data adding up.
These surveys are giving a consistent signal that we are seeing some more concerning weakness in the labor market. We think that means the Federal Reserve has room to cut interest rates here.
A conversation up next with Kelsey Berro of JP Morgan. We've got baseball bants. Do you want to do baseball bants?
I like what Vito left the studio saying. The only shutdown he likes when the Yankees shut down the Boston Red Sox, which we did last night. Fantastic game.
So that's game
and
2.
Vito was there, so I'm a little jealous.
When's game 3?
Tonight. Do you want to go?
Okay, no, I don't.
I'm looking for someone to go with.
Okay, if anyone's listening and would like to go to the baseball, maybe you have a suite. I don't know.
Yeah.
I don't think you can accept that.
Yeah, well,
You know, all right, okay. Let's move on very quickly. Equity futures on the S&P 500 positive by 0.1%, on the Nasdaq up by 0.4. Under surveillance this morning, signals in the data adding up.
These surveys are giving a consistent signal that we are seeing some more concerning weakness in the labor market. We think that means the Federal Reserve has room to cut interest rates here. They still have rates that are above neutral. Getting back to that is very reasonable. We think they cut interest rates, a couple of more times this year.
So here's the latest this morning. Traders betting the Fed will cut interest rates twice this year after private sector payrolls unexpectedly dropped in September. Kelsey Berro of JP Morgan Asset Management writing, recent labor market data confirms that slack is still growing. A soft labour market justifies additional rate cuts by the Fed. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Do we not need NFP tomorrow or claims today? We're just on a one-way street to another rate cut?
I think we probably are. I'm sitting here looking at the echo screen kind of longingly, knowing that we're not going to be receiving that data. Yeah, I mean, it's a bit of a strange feeling. But I do think that we have enough corroborating evidence, whether it be in the ADP data or whether it be in surveys, like the Conference Board has the jobs labor differential, so jobs easy versus hard to get. Those are all really trending very similarly in the same direction, which is slowing. We're seeing it on the private sector side. We have risk of more job cuts on the public sector side coming, depending on how this government shutdown evolves. And so I do think that, the Fed still views policy as at least modestly restrictive. And so there's space to cut rates at least through the end of the year and then pause and reevaluate.
In the quote we used, you used the word slack. Now, we've certainly had a step down in payrolls growth. Have we really seen an increase in slack? Two kind of different things. One can inform the other. But given the supply side developments that we've seen over the past year, how are you measuring where we are with the slack story?
No, I mean, that is a really good question. And I think one of the reasons why the market has been taking the slowdown in jobs growth in stride. Now, the reason that I'm skeptical that we can just dismiss the slowdown in jobs growth as exclusively a function of falling labor supply and falling immigration is when I look at those surveys of consumers, whether it be the New York Fed or the Conference Board, if this was all about just slowing hiring because there wasn't immigrants to fill the roles, then why would respondents be saying that it's so hard to find a job? Particularly those of the lowest income and lowest education level, which is also the area where immigrants tend to be the highest share, non-legal immigrants tend to be the highest share of employment. So to me, I think that there is evidence that it's not just a labor supply story. It is a labor demand story, and there is legitimate reason to be protecting against the downside risks to jobs.
I buy the story about real weakness in the labor market. You look at the quits data and you look at how much the quits rates come down. A lot of it verifies this idea. It's not so great to get a new job. It's not terrible, but it's not so great. I just wonder if rate cuts are the answer, given the fact that financial conditions are as easy as can be. And ultimately, what rate cuts are supposed to do is prompt investment from companies that already are investing at some of the fastest paces that we've seen in years.
Yeah. So this is a really interesting point about investment. So what I've been doing recently is really trying to understand this dichotomy between the strong growth data, the strong GDP data, and the weak labor market data. And what I think people, not in the equity market, they're definitely appreciating this, but on the bond market side, you've mentioned that it seems like the bond market is looking at the labor market data and interpreting it as this is a bad sign, the Fed's going to need to cut rates more, while as risk assets are saying, it's great, the Fed is cutting rates and growth is still fine, layoffs are still low. What we've noticed is, the GDP data has been very highly concentrated in the AI sectors. So if you look at software investment, intellectual property investment, those are running around a 30% annualized rate in the first half of the year. If you exclude those, GDP growth is actually pretty muted, pretty close to zero, and more in line with the labor market data. So it does go some of the way in explaining some of that divergence.
Yeah, but if you overlay the idea of rate cuts and trying to juice the rest of the economy through the monetary policy mechanism, isn't the risk of a bubble or a risk of some sort of excess that much greater, given the fact that everyone is betting on this and saying, look, they've got our backs. We can buy anything and we can pay whatever we want for it and we'll be made whole?
I don't think that that's a new phenomenon. I think we have experienced a series of shocks over the last 5 years since COVID, where policymakers have shown to the market time and time again that they're willing to step in with unique and unconventional policies to backstop things. And so far, they've been successful.
Are we breaking down the traditional correlation between the labour market and credit? How does this all shape your views about what's happening with fixed income on the credit side?
Yeah, and this does go to this idea that, we talk about the K-shaped consumer, but there's also a K-shape in terms of businesses, and when we're talking about capital markets and IPOs and all of the M&A and all of those discussions you're just having with the last guest, that's only a subset of America. And when you look at the majority of hiring in America, it's done by small businesses. And so our credit analysts continue to look at that subset that is linked to public markets, capital markets, can raise debt, by investors here in asset management. And their balance sheets are solid. So I do understand, why those spreads are tight because of those fundamentals. They have the flexibility to maintain their operating margins. It's just a question of the haves and the have-nots, because if you're a smaller company, you don't have that flexibility to manage supply chains and to absorb the costs of tariffs like the small companies. And that's why you see in the ADP data yesterday, the only area where jobs were growing was in companies with 500 or more employees.
Yep.
The rest of the economy was seeing job losses.
Two different worlds. Kelsey, great explanation. Good to see you. As always, thank you. Kelsey Berro there of JP Morgan Asset Management. Coming up next, Sarah Hunt of Alpine, Saxon Woods, Krishna Guha of Evercore, Yelena Shulyatyeva of the Conference Board, Mike Pyle of BlackRock. The second hour of Bloomberg Surveillance, just around the corner.
This is a year full of disruptions, contradictions.
The market is in a very strong place.
That sort of streak of upgrades, that's the most bullish thing that you can imagine.
You need pockets of irrationality, but you ultimately need rationality to prevail.
There's still money that can be dragged kicking and screaming into this market.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Have you heard this little voice going out to commercial break about
so
5
lame.
minutes ago? That was the most half-baked go Mets I've ever heard.
They're so bad.
Well, honestly,
Stevie Cohen, if you're there this morning, good morning. I hope you didn't witness that.
ridiculous.
You've got any more pride than that?
Well, it's not about pride. It's about I had to sort of defend after the just evisceration.
Whispering "Go Mets" is your way of defending.
Frankly, at
your
this
club.
point, that's about as good as I can get right now. Yes, that's correct.
Let's start again from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures on the S&P 500 positive, up 0.1% following a 4-day winning streak coming into October. First trading day, all-time highs. We had some weight to the rally. In the bond market, yields down to the front end of the curve, across the curve through yesterday's session off the back of worse than expected data. Both ADP, ISM manufacturing not too great either. 2-year bond yields this morning, 354. As for the economic data, what you will get, what you won't get. What you probably won't get is jobless claims later this morning at 8:30 Eastern Time. Likewise for payrolls tomorrow morning. What you will get, ISM services is going to take on even more importance going into the weekend.
Yeah, I just wonder how much the market's going to really respond to bad data. And when I talk about the market, I'm talking about equities, because right now bad data seems to signal to bond market risk on. And it's sort of in terms of buy bonds, and at the same time it signals to stocks, buy stocks because bonds are rallying, so yay. It seems like there are two different tracks right now, and I just wonder, to your point, whether ISM services is different than the labor market and indicates something more about consumer appetite that could filter in to equity appetite.
Well, we're not getting the data this week, and I think the big question is, are we going to get the data in the next 2 weeks? Are we going to get CPI on October 15th? How long is this government shutdown going to last? At the moment, no one's blinking. The Republicans aren't blinking, and the Democrats aren't blinking. What the Republicans are doing, though, is they are making it incredibly uncomfortable to try to bring the Democrats to the table when it comes to freezing, talking about layoffs, freezing of funds and layoffs, things like this. But does that backfire? And if it does, we could be here for a much longer time.
Lisa said this yesterday, and I think you're absolutely right. It's not just that this data might be delayed. The data points we are getting this week might be the last clean data points we get for maybe a couple of months.
Yeah, and here's the problem. It's muddied by a lot of the data that already has been revised. I'm thinking about even ADP. It came out 2 consecutive months of job contractions. Oh my goodness, falling off a cliff. But, to use Libby Cantrell's phrase, we're looking at a revision based on the quarterly household survey that probably was overestimating how much of a downgrade. So people are parsing through this and saying it probably doesn't matter, but the bond market says let's rally anyway because that's going to be what the Fed uses. I just wonder how long this can continue. For the bond market to rally on one thing, for the stock market to completely ignore that weakness, rally on something else, without anything breaking down.
If you're at the Federal Reserve and you've got a bias to cut interest rates right now, I think you've still got a bias to cut interest rates at the end of this month. If you're just joining us, welcome to the program. Equity futures on the S&P positive here by 0.2%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as Wall Street shrugs off the shutdown. Krishna Guha of Evercore with data delays muddying the Fed's waters, and Mike Pyle of BlackRock as big tech investments make the US the AI leader. We begin this hour with stocks reaching record highs despite the chaos on Capitol Hill. Sarah Hunt of Alpine Saxon Woods writing the government shutdown may or may not impact a raft of data. For investors, this may be the trickiest part, at least in the near term. Sarah joins us now for more. Sarah, good morning. Good to see you. Good morning. Do you think this will hold back risk appetite this month? No sign of that just yet. Do you think it will?
It depends a lot on how long everything takes and what kind of data comes out in the interim and the kickoff of Q3 earnings season, right? So all of these things are going to be important. Earnings season is going to take on even more importance if we have a lack of government data because people want to see what companies say. But I think this morning the news on ChatGPT was one of those, OpenAI was one of those things that certainly helps the situation and doesn't hurt it.
Just build on that a little bit more. Why does it help the situation sitting here this morning and understanding that you've got this private company staying private worth $500 billion? Why does that help?
It helps because the question has been all along, AI has been fueling this rally, right? You take that out and all of a sudden the statistics do not look nearly as good. And if you see cracks in that story with the other problems that are going on, I think you have issues. The fact that you saw a data point that's positive, take it as you want, whether or not that's too bubbly or whether or not it's anything else. The bottom line is people are willing to put up some serious money to be a part of that story, and that's still the case. That is going to help the equity markets just because it underlies that foundation and it gives it more confidence.
So don't fight AI. Is there increasingly a feeling in your mind, don't fight the Fed, in terms of supporting the rest of the non-AI universe that hasn't fared as well?
Well, I think the Fed has a very tough job going into the next couple of months. A lack of data doesn't help it at all. And yet, to your point, the ADP numbers, people are going to look at that. They're going to look at any non-government data that comes out, because until we get government data out, you don't have enough information. But directionally speaking, I think that one of the reasons you saw that happen yesterday was that people thought, well, this is another excuse to cut rates. Whether or not that actually solves any problems or does what it's supposed to do is another question. But the idea that it's coming is still positive for equity markets.
I just wonder how long you can turbocharge growth before inflation becomes a problem. So a lot of people have said it's not. And at the same time, you start thinking, if we're already above that 2% target and you add juice to what already is a strong economy, albeit concentrated in AI, doesn't that become a real concern later this year?
Well, I still don't think that we've seen the true dynamics of the tariff pricing in pricing, right? So whether or not that's going to come in as the price level raised or it's inflation, I don't think that that's really come through. You've seen big waves of inventory every time there's been a pullback in timing on those tariffs. So the companies have been absorbing a lot. There's a point at which that script flips. And I don't know where we are with that yet. But as that sort of comes in, I don't see how it can be beneficial.
So what are you worried about now? Because you don't sound like you're that worried about a bubble when it comes to AI. You don't sound that worried about a government shutdown.
I worry about a lot of things. I wouldn't go so far as to say I'm not worried about a bubble, but the problem with that is that bubbles can go on a lot longer than we can think about whether or not they should. And if there is enough real money chasing that right now, as opposed to the whole argument about debt and debtor financing that came back around with that big deal, right? So as long as people are putting up money to help solve that problem, I think it's less of an issue. I think it becomes one when people start to worry about whether or not there's any actual productivity that's going to come out of this, efficiency that's going to come out of this. And I think that that's still one of those questions that we're struggling with.
It's a good point. The end of the 90s, when Greenspan talked about irrational exuberance, we had a bull market run for 4 years. But how do you time it?
That is a great question, and that is the problem, because you only see that in retrospect when people finally start to look back and go, you know what, we were wrong at X point, at Y point, at Z point. Right now, we're still looking at that and saying there's still a lot of promise. We collectively as investors, I'm not speaking about us just generally personally, but the investment community is willing to look at that and say that there's a whole wave coming. And even though you know there will be inefficiencies in that wave, people aren't sure where they're going to be yet. So at some point, it starts to be kludgy, where you don't get some people coming out and saying, this is helping our margins, this is doing that for us. We need to see that come through. And that's still a promise right now, and market loves a good story.
There seems to be some great division over the balance of risk. I think the Fed's got one view and the market's got another. The Federal Reserve believes the biggest risk right now is downside risk to employment. And a lot of people in markets are coming around to the idea that the biggest risk might be upside risk to inflation. And they're chasing that because the Fed's going to respond to one and not the other. This is what Torsten Slock of Apollo said just yesterday. Upside risk to inflation are growing, particularly if the Fed continues to cut interest rates. And he believes his whole profession continue to underestimate this economy and the resilience of it. Are you coming round to that side of things as well?
Well, it's interesting because the resilience of the economy also bakes in a number of things. So Kelsey Berro was just talking about the difference between big corporations and small corporations. So it bakes in a lot of positive movements across the entire strata. I don't know that the entire strata is performing that well, but from market's perspective, it doesn't really matter. Lower-end consumers aren't doing that well. Stock market doesn't mind. They don't spend the most money anyway. If you can continue to see cash flow in those big companies, it's less of an issue than if Main Street is struggling on the smaller side. So it really does depend, but I do think that inflation is an issue, and I do think that it could be a bigger issue going forward, but if we're not going to get some of that data, it makes it easier to ignore. On the other hand, I think that it is definitely something that continues to flow through, and that's going to be tricky because what happens with that is you fix margins by getting rid of people, and then the labor question becomes even more problematic. And then the Fed is in a very difficult place, which I sort of think they are anyway.
I'm looking at where to buy gold bars right now, and I'm wondering... Costco. There's Costco. There are places, though, they limit how much you can buy. You have to be a member, and then it's only 1 bar per person. I'm looking at this. How much is that sort of the solution increasingly for people? I know that you say that personally is one thing, but increasingly, how mainstream is that type of investing really becoming?
Well, I think that gold and to some degree Bitcoin, and I wouldn't call gold Bitcoin, digital gold or anything else, but they are ways to express an opinion that the system itself is going to have some problems, and that government, all currencies are going to have to devalue against something, right? So gold is one of those things that people look at and say, I can buy gold. It doesn't matter if it's a Euro U.S. thing or if it's a Japan U.S. thing. I know that if currencies are going to be devalued, I've got something that should rise in value. And whether or not that's a truism or people argue it or it's just, people are chasing it, central banks are going back to buying gold to some degree. They certainly seem to have been on the non-OECD side. So I think that there is room for that to move because it hasn't moved in so very long. And we just topped inflation-adjusted gold prices in the 70s and 80s. And that is one of those, technical markers that people look for.
Well, is that something where you're starting to credibly look at that as a real slice of the sort of more risk-averse side of the portfolio in a way that you hadn't before?
Well, I think the tricky thing is that after it's had such a big run, it almost seems difficult to say, now this is the time to go ahead and say that this should be a part of your portfolio. If it was before, you're feeling pretty good about it. If it isn't now, you're looking at that going, can I jump in here and buy something that's elevated so much? And I think this goes back to all risk assets are going in one direction and whether or not that can continue. And it's difficult to jump in and say, yes, I want to put a chunk of something in that asset that's run that much. But you could certainly layer in a little bit and see what happens so that it gives you a chance to layer in a little bit more, just because it's an opposite to larger financial systems.
Another record high, creeping up towards 4K, 6-day winning streak up almost 48%. Year to date, which is just wild. Sarah, thank you. Sarah Hunt there of Umpire Saxon Woods. Gold up again this morning. Let's give you an update on stories elsewhere with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump is seeking deals in 20 to 30 critical industries ahead of the 2026 midterms. Reuters is reporting pharmaceutical executives at Eli Lilly, Pfizer and AstraZeneca are getting near daily calls from White House staff. The deals would include taking equity stakes and offering regulatory relief in exchange for concessions. Intel is reportedly in talks to add fellow chipmaker AMD as a customer for its manufacturing business. Semaphore is reporting that the companies are in early stage discussions about having AMD rely on Intel. AMD currently depends on Taiwan Semiconductor for much of its manufacturing needs. The U.S. Supreme Court refused to allow President Trump to immediately oust Federal Reserve Governor Lisa Cook as she sues to keep her job. The court's order means Cook can remain in her position until at least January, when the justices will issue a new ruling after hearing arguments over her alleged mortgage fraud. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate the update. Up next on the program, Flying Blind.
Supply-side dynamics are very different this time around than they've been any time over the past few decades. This means we're flying blind in a highly foggy environment, and this is very risky.
In just a moment, we'll cash out with Krishna Guha of Evercore to get his view on things, and Mike McKee will break down the data you will get and the data you won't get in just a moment. From New York City this morning, good morning. Stocks are up following a 4-day winning streak. We're up again by 0.2% on the S&P. On the Nasdaq 100, up by 0.5, up by 0.4 on the Russell 2000. Under surveillance this morning, we're flying blind.
We are still in the midst of an environment where there are a number of supply shocks affecting the economy. Too many people are still reading the economy as if it were guided by demand shocks. This is not the case. Supply-side dynamics are very different this time around than they've been any time over the past few decades. This means we're flying blind in a highly foggy environment, and this is very risky.
So here's the latest this morning. US economic data at risk of being delayed due to the ongoing government shutdown. The Labour Department already sharing jobless claims will not be released later this morning. So what will you get? What won't you get? Here's Mike McKee with more. Morning, Mike.
Good morning, John. Well, what won't we get will outweigh what will we get. And it's going to be hard for the next week or so for the Fed and for investors to really get a good picture of what's going on in the economy. What won't we get? Well, we're not going to get jobless claims, as you mentioned today, not going to get factory orders either. And the big one, September payrolls, is going to be delayed to some point. Tuesday, the trade balance is not going to come out. And Thursday, once again, jobless claims and then wholesale inventories. It's not a big week next week. So it's not as bad as it could be, but it is definitely bad news that we're not getting tomorrow's numbers. What will we get? Well, there are a few things on the private sector side that are coming out. ISM services will be out on Friday. The New York Fed inflation expectations number is out Tuesday, and then next Friday, the University of Michigan sentiment. Going to be interesting to see what Americans say about all that. And just because we got nothing else to do, the Fed is stepping in and is going to have a lot of Fed speak next week so that we can keep up with their thinking on all of this. Almost something every day. Today, Logan and Goolsbee. Tomorrow, Williams, Logan, Jefferson, and Myron. Tuesday, Myron and Kashkari. And as you can see, more on Wednesday and Thursday, including the Fed minutes from the last meeting, may take on a little bit of extra import because there's nothing else.
Mike, as you know, we've got a low confidence consumer, but we've got a high confidence investor. And we're seeing companies, or at least investors in companies, get excited about the prospect of growth in 2026. Now, you'd expect that to correspond with hiring intentions, Mike. And I just wonder whether the economic data is contradicting that message.
Well, the data we're getting so far suggests that it is, in the sense that companies just aren't hiring. Challenger, Gray, and Christmas, with their job cuts announcements, also announces hiring plans. And they're reporting in September that companies announced plans to add 117,313 jobs. That's down 71% from a year ago. It also suggests that they are going to hire fewer people for the holidays. It's the lowest since 2011. From January through September, hiring plans are the lowest since 2009. So right now, companies are not hiring, not firing as many people. Firings were down 25%, but the number of people who are going to get hired, very low still.
Mike, stay close. Always good to catch up. Mike McKee breaking down the economic data you will get and probably won't get. Krishna Guha of Evercore is looking for a rate cut month end. He says this: our further lean into October reflects the even lower probability post-shutdown the Fed will get enough reassurance on labour market to rein in the soft default of successive cuts through the end of 25. Krishna joins us now for more. Krishna, welcome to the programme, sir. When do those decisions start to become a closer call, start to get just that little bit harder?
Well, look, right now you could actually make the case against the baseline 25 basis point cut in October in two directions, right? You could say, well, growth, it might be picking up. The markets are looking strong. The JOLTS and other official data hasn't shown any break. The downside, so what's the hurry with a cut? You could make the argument the other way. ADP looked a bit scary yesterday. Perhaps labor market weakness is intensifying, and maybe we should consider a 50. I think the reality is 25 in October is just a very, very solid default. I think that the meeting that is up for grabs is December. And the question will be, what does the cumulative information between now and then tell us relative to what is still a baseline further 25 in December? Is it suggesting an accumulation of risk to the upside or an accumulation of risk to the downside? Otherwise, you're going to get that 25 followed by the 25.
Krishna, a lot of people agree with you. The markets agree with you. And right now, it's don't fight the Fed, buy brisk. And I wonder, financial conditions matter when stocks are going down. Financial conditions don't matter when stocks are going up. Is this essentially a Fed put where the Fed does not care, as long as things are not weakening, about cutting rates and what that does to potentially elevating asset prices?
Right. So what we've been emphasizing is that this is an incredibly risk-friendly moment because of this growth labor divergence. Right. So it looks like the growth side is fine, even maybe firming a bit, although we need to keep an eye on segments of the consumer. On the other side, the labor side is at a minimum soggy and perhaps weakening more. Fed, taking its cue from the labor side, is going to cut into that decent, perhaps improving outlook on the growth side. There's nothing not to like about that from an investor perspective. Now, the question is, as you said, does the fact of a buoyant market then come back into the Fed's reaction function? I think we heard loud and clear from Powell's latest remarks on this that they have their hands full balancing between employment risk and inflation risk. And financial markets, while in some level always factored into their deliberations, just can't drive the bus in this moment. So I think, the market wasn't quite sure what to make of those comments by Powell, I think about a week ago. But I think it made it very clear that they are focused on employment risk relative to inflation risk. And if making the right call in their eyes on that macro risk management is associated with markets going up, that's all right by them.
At this point, I wonder about the K-shaped consumer then and what this means for spending early next year and thus inflation. If you have the wealthier consumer seeing their 401ks, seeing their portfolios going to the moon as a result of this policy, how much does that juice spending and juice the inflationary momentum under the market heading into 2026?
Well, we actually think this is a K-shaped economy in two respects. First, the one that you absolutely correctly identified, the upper end consumer with the wealth effects versus the low to middle end consumer with less labor income growth adjusted for inflation. But there's also a K-shaped a recovery in terms of business sectors, right? You have the AI related sectors strong for secular reasons. You have the other sectors weighed down by uncertainty, by the drag from tariffs, by weak labor supply, which also, of course, weak growth in the number of consumers for many businesses. So you have a K-shaped economy in two really core dimensions. Now, as we look into next year, in a sense, the question is, well, how does that K-shape resolve itself? Does it resolve itself, A, with other sectors gradually firming as uncertainty recedes and some of the tax impacts support the economy? Or does the K-shape collapse the other way with AI spending perhaps plateauing and therefore no longer fueling that growth? Or in fact, do we continue to see that sectoral divergence? And then in terms of the consumer, is the consumer staying driven by asset prices? Then you're going to keep that K? Or are we going to see that some broadening of economic growth feeding into more hiring as uncertainty recedes? I think a key question is whether, as uncertainty moderates, which we assume it will moderate, is there a handoff from uncertainty to spreading AI productivity impacts, which mean that the growth side remains relatively soft relative to growth in 2026? That's the environment, of course, that would take this very risk-friendly moment into a much more risk-friendly secular phase, as companies were able to profit from growth without having to add labor. And of course, because the labor side would be soggy in that scenario, the Fed would still be able to deliver further rate cuts next year.
Krishna, besides the lack of data we're going to get because of the shutdown, what do you think the impact's going to be? Neil Dutta put out this note saying it doesn't feel like it might be the same song and dance. He says it's coming at a fragile time and some government workers might actually save more, maybe not spend because they're concerned about a prolonged shutdown.
So I think you're completely right that, this is a, shall we say, unfamiliar political situation in just so many respects in the US right now. And so we've got to be careful, not to be too sanguine just based on, historic track records. With that said, my colleagues who are expert in this area are relatively optimistic that we might be able to get the shutdown resolved within a week or two, because there are incentives pushing, particularly more moderate folks in the Senate, towards compromise in both directions. On the Republican side, I think there is some anxiety that they could end up getting pinned for this shutdown, and a recognition that actually they may need to fix some of the Medicare, the medical subsidies. Otherwise, that'll be an electoral problem for them in the midterms. On the Democratic side, real concern about federal layoffs and a more extended shutdown in that direction. So we are cautiously optimistic that in spite of all the poison in Washington right now, and to some degree, sadly, in the country at large, that more likely or not, we actually will, the basic forces of compromise will push the two together, perhaps on a 1 to 2 year, 2 week type time frame. But I certainly wouldn't exclude the alternative.
Krishna, the clinic, as always. Thank you, sir. Krishna Guha there of Evercore ISI on the Federal Reserve, and just why this is such a risk-friendly moment for financial markets. Up next, Yelena Shulyatyeva of the Conference Board as the labour market braces for possible layoffs. Krishna Guha of Evercore was absolutely fantastic just moments ago about why this moment is so risk-friendly. We talked about the corporate earnings labour market divergence. One is strong, the other is weak, and the Fed is responding to one and not the other, which is why so many people are comfortable chasing asset price inflation right now, and why one of the trades of this year has been to be long stocks and long gold.
Yeah, because ultimately stocks is a play on AI, but it's also a play on the idea that the Fed doesn't care about market conditions as long as the market's going up. Financial conditions only become an issue when markets go down. Money printer, let's do its thing.
Markets keep going up. 4-day winning streak on the S&P 500. Let's make it day 5, up by 0.2% on the S&P. Do you want the sound effect with that?
I don't want to get criticized again.
It's got a B on the front.
She was trying
the meme has a B on the front.
She was trying to get you to do it. I knew you weren't going to fall for it, but I was prepared.
Don't we have things to get to?
You want some of those buttons on the table?
Oh, I think that would be so good.
That's a different program. In the bond market, 2-year, 10-year, 30-year bond yields shaping up as follows. We look like this. 2-year yields at 354.29 on 10s, 4.09%. With your single names this morning, your morning movers, here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Let's begin with AMD because to a certain extent this is a halo effect right from the OpenAI valuation now to $500 billion now. But also it's the second day of gains for AMD on reports from Semaphore that it's in talks with Intel for it to supply Intel its manufacturing needs. Now, AMD had been reliant on TSMC for most of its manufacturing needs, so that would take out some potential geopolitical thorniness out of that equation as well. Now, talks are still in the early stages. Intel had a big run up yesterday. As you can see, Intel is lower pre-market. Moving on to another AI-related name, and that's Nebius. Look, another 5.7% pre-market. Now, Nebius is like CoreWeaver Lambda. It's this new type of company that essentially rents out AI cloud ability, if you like, cloud vendors. Microsoft's deal worth more than $19.4 billion. Now, we knew of this deal from Microsoft back in early September. The stock spiked then, but now we have more specifics. As part of it, Microsoft is freeing up its own capacity and it's benefiting the likes of Nebius. And then let's finish off with a car maker. They're going to be in the news today, but Stellantis this time up 7%. Considering a potential sale of Free2Move, that part of the business, we know that the CEO, Antonio Filosa, is looking to turn around Stellantis and present a new plan to investors in the first quarter of next year. We also know he's trying to exit unprofitable businesses. He's brought in McKinsey to look at strategic advice from Maserati and Alfa Romeo, for example. But we also know the company has explicitly said that Maserati is not for sale.
Vonnie, appreciate the update. Vonnie Quinn there. Thank you very much. More from Vonnie later this hour. On a radar this morning, OpenAI completing a deal allowing employees to sell shares at a $500 billion valuation, making it the world's largest startup. The deal coming as OpenAI negotiates with Microsoft to convert into a for-profit company. And check this story out. President Donald Trump saying he'll press Chinese leader Xi Jinping to restart purchases of soybeans when they meet at the end of the month. Beijing hasn't bought any soybean cargo from the current harvest, instead relying on Argentina and Brazil.
This is becoming a huge problem for this administration. But remember, Trump won. We did say, in the end, about $28 billion in terms of a bailout to the farmers. So we could see that again. Trump's talking about all the tariff revenue coming in. We might need to give that to the farmers. But this is becoming incredibly uncomfortable for the administration politically, given the fact that the Treasury Secretary is talking about extending some sort of financial lifeline for Argentina. And guess what Argentina's doing? They're sending their soybeans and taking advantage of this moment to China. And the political question is going to be, for this administration, if you are going to help Argentina, should they not be alongside you putting up the walls when it comes to China?
This is exactly where I was going to go. The idea that soybeans are becoming ultimately an arbiter of who our allies are and who they aren't. And this does create a quagmire for Argentina. And right now, you're seeing a real test of the pledge that we saw from the Treasury Secretary, Scott Bessent, saying that we're going to support this economy, we're going to support the currency. And traders are saying, oh, yeah, how about those soybeans? And guess what? They're challenging them. And that's going to be a real question. Does the U.S. actually step in to make good on some of those promises?
Did you see that photo in the last week?
Yes.
The Agriculture Secretary.
Brooke Rollins
texted the Treasury Secretary.
Texting Scott Bessent, basically complaining, this is a big problem I'm having in the Midwest. We need to talk about it. And guess what? Milei is going to be coming back to the United States, according to Argentinian reports. And this is going to become incredibly political for this administration.
It's something the White House will no doubt address in the coming month, that's for sure. The White House also needing to address this. The Budget Director, Russell Vought, planning to swiftly dismiss federal workers as the government shutdown continues. Vought telling House lawmakers that some federal agencies will terminate workers within 1 to 2 days.
So they're trying to make this very painful for the Democrats potentially carrot and stick approach to come to the table, or they're trying to use this crisis to actually shrink the federal government, which we saw them do with Doge. The issue this administration is going to have is this is going to end up going to the courts, and maybe these people are going to end up back in their jobs.
Let's stay on the jobs front. Sticking with the federal job cuts, Yelena Shulyatyeva of the Conference Board writing the following: impact on official unemployment rate from a shutdown, if not furloughs, but permanent layoffs, could be anywhere between 0.1 to 0.5 percentage points, not including the spillover impact on the private sector. Yelena joins us now for more. Yelena, good morning.
Good morning.
We've heard this phrase so many times: low hire, low fire. When does the low fire start to change?
Well, the low hiring doesn't need to result in the layoffs. Just, mechanically it doesn't happen. But it raises the risk of the layoffs. And the federal job cuts could actually exacerbate that trend. So I think, we have this shutdown dynamics right now, and it's very difficult to look at the data without having the data. But what our labor differential index says that the risks are rising, and I think we are entering a very difficult time.
So how does this cohere with what we're seeing in the rest of the market, where we are still seeing consumer spend, we are still seeing activity rebound, we are still seeing some hiring on the margins as companies gain confidence for the path ahead?
I think you're right. The hard data seems to contradict the soft data, which is the survey data, including the Conference Board survey. I think it's a timing issue. The big test for the consumer will be at the end of the year during the holiday shopping season. We do see prices rising, and consumers actually take a note of that, and they are telling us that they are very much concerned about it.
How difficult is it to aggregate data right now when each region in the United States is acting kind of as though it's dancing to its own music?
True, and especially like if you look at the DC region, for that matter, or the other parts of the country, we're just talking about agriculture. So I think you still can look at overall numbers, and the overall numbers are telling us that things are weakening, the risks are rising. And the Fed will probably take a note of that. I think if you look at our data at the Conference Board, you will see that 9th consecutive decline in the labor differential index. It's an established trend. So that tells you something. That tells you that the risks are rising.
But isn't it difficult to really understand what is impacting the labor market at this moment when basically entry-level jobs, we don't understand? Is it actually there's no need, or the need has been outsourced to artificial intelligence?
So that's a separate question, of course, and it's a big concern for young adults, for the housing market, because that affects the housing market when young people don't have jobs. But I think, again, if you look at our data, we see a broad-based concern. Consumer confidence has been trending down for all kinds of income levels and groups. So you do see a broad-based decline in those measures.
You also mentioned regions. Is it going to get worse for the D.C. area if we have a very prolonged government shutdown? Virginia, Maryland, this is the place where a lot of federal workers live.
And not just the federal workers, everybody else who depend on them. Think about a food truck. You go for a lunch, or you will forego that service. You will not be able to recuperate, right? You can buy goods when the shutdown ends, but services could go away forever. That is something that you cannot recapture.
Have the hawks on the Fed got a credible argument? And what is it?
Well, inflation will rise according to our forecast. It's taking time. You guys talk about this on the program all the time. It's a process, and I do agree with that. We do see inflation rising above 3% by the year end in terms of PCE inflation. And that will get into the consumers' minds, and that's why we expect
Will it get into the Fed's mind? Will they be uncomfortable cutting interest rates when we get back to a 3 handle? And I know we're super close right now, but when you're above that number, does the story change? Does it get harder?
It will feel uncomfortable for them. There will be a lot of disagreement on the Fed. But look at why they cut rates at the September meeting. They cut it because of the risks, not because of the data. They cut it despite the data, quite frankly, right? So look at the materials that accompany the Summary of Economic Projections, where they talk about the risks. They have a special metric there, and you see the rise in employment in employment mandate risks, essentially. And that's why they cut. And the data that we do have is actually telling us that those risks continue to rise.
I feel like we've been spending the past 6 months saying we're in a dark room, we don't know what's going on, and we're still kind of in the same place. And I feel as though we're not really moving forward on the macro front in terms of having better visibility, which is the reason why people are going all in on AI and some of the trends they can identify and study. Has there ever been a time where it was more difficult for you, looking at all of this data, to project out where you expect us to be in 2026, where there is actually a fairly narrow range of possibilities that seems likely?
Well, we do run some macroeconomic models, and those big, models are telling us the impact, say, from tariffs will be actually really, really big. But we don't know, right? We don't know. We don't see that in the data. So that is very difficult. Trends have changed, but it doesn't mean that the economic laws will be broken altogether. So I do still believe that there are some relationships in economic data that will hold. So it's just a matter of time, I think.
Jobs are not plentiful. They're hard to get. We see that in your data, in the labour differential, and we appreciate your time. Thanks for being here.
Thank you.
Thank you very much. Yelena Shulyatyeva there of the Conference Board. Let's give you an update on stories elsewhere. With your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. At least 2 people were killed in a vehicle and knife attack at a synagogue in Manchester during Yom Kippur services. UK Prime Minister Keir Starmer cut short a visit in Denmark to chair an emergency meeting, writing this: additional police assets are being deployed to synagogues across the country. We will do everything we can to keep our Jewish community safe. Citigroup is now the main home for President Trump's money. Sources telling us here at Bloomberg the relationship started after CEO Jane Fraser called and congratulated the president on his second-term win. Banks were previously unwilling to take on Trump's wealth after failing to repay loans tied to his troubled business dealings. Tesla CEO Elon Musk urging his 227 million ex-followers to cancel Netflix subscriptions for, quote, the health of your kids. Musk making the comments to criticize a Netflix show featuring a teen protagonist who is trans. The animated series ran from 2022 to 2023 and has since been cancelled. That is your Bloomberg brief. John.
Hey, Vonnie, thank you. Those earnings come from Netflix on October 21, so we'll see if that shows up in subscriptions. Up next on the programme, more of a boom than a bubble.
We think that over the next 2-year period, that's where you're really going to start to see some of those efficiency gains, some of those benefits from AI adoption. I would call it more of a boom than a bubble.
That conversation up next. Mike Pyle of BlackRock joins us in just a moment, live from New York City. You're watching Bloomberg TV. Stocks are positive by 0.2% on the S&P 500, starting October and Q4 at all-time highs on the S&P. 4-day winning streak could become day 5 on the Nasdaq 100. We're positive also by 0.5% in the bond market. 2-year, 10-year and 30-year. 2-year yields plunging yesterday following that weaker than expected ADP report. ADP, of course, taking on additional importance this week because we won't get claims later this morning, 43 minutes from now, and we probably won't get payrolls tomorrow morning at 8:30 Eastern Time following the government shutdown. Wanted to finish on the week ahead. No payrolls, no jobless claims. The ISM is kind of it right now going into the weekend. ISM services.
Yeah, and just think about how much the market can move on the heels of it because it is the only game in town. If you talk about that 2-year yield move, it was the biggest move in the 2-year yield going back to the August payrolls report when we saw a complete reset of what Fed policy would be going forward. And that's for a data point that has been highly contested in the past and in yesterday's revision. So take it for what you will.
So there's a feeling we get to the end of October, we cut interest rates again, and then maybe the decision after that is harder. December time when you have to put out new forecasts, maybe inflation's closer, or maybe it has a 3 handle. And does that make that decision to cut interest rates that little bit more uncomfortable?
The answer from markets, nope. Not at all, because what you can see from Fed funds futures is essentially almost a 100% chance of a Fed rate cut at the meeting later this month, and then again in December. So right now, it doesn't seem like that tough of a call, at least in the market's eyes, which seems to be influencing a lot of different trades right now.
Asset price inflation, a place to be apparently for both equities and gold and Credit as well. Seeing it across the board. Under surveillance this morning, more of a boom than a bubble.
I really don't think that we're currently in a bubble state. I would call it more of a boom than a bubble. Valuations are very rich. There's no two ways about that. It's a tough time to justify adding risk, but we do think the demand for compute is there. We think that over the next 2-year period, that's where you're really going to start to see some of those efficiency gains, some of those benefits from AI adoption.
So here's the latest this morning. AI optimism pushing global equities to fresh highs. Mike Pyle of BlackRock writing, we think US equities will regain global leadership as the AI theme keeps providing near-term earnings support and could drive productivity in the long term. Mike joins us now for more. Mike, good morning. Good to see you.
Great to be here.
Let's get into that quote and some of the things we've been talking about so far this morning. Why do you believe this is such a risk-friendly moment for financial markets?
So, a couple of things. One, I thought Krishna just a moment ago really captured the macroeconomic and Fed dynamic well. A strong growth environment, at least a resilient growth environment with labor market weakness, giving the Fed room to cut. That combination of pretty strong growth and a Fed cutting, that's a positive backdrop for risk assets, particularly when combined with a theme like AI that has such potential to be transformative and we think is increasingly an important anchor for global portfolios.
Let's build on that. How difficult is it to get used to the idea that we can have a step down in payrolls growth, but a step up in earnings? That's something typically I think people would struggle with, but that seems to be what's happening right now.
Yeah, agree. I mean, I think one way of squaring the circle, while agreeing that at the top line, we're seeing exactly that. We're seeing capex growth. We're seeing consumer strength in aggregate. At the same time, that K-shape is real. And again, I thought one of the things that was well discussed earlier was this K-shape isn't just about consumers, it's also about the business sector. And I think one of the things we saw in the updated GDP numbers a few days back was, as we were going through Q2 earnings, we were saying, large corporates, large public corporates seem to be quite resilient. But when you look at unlisted companies, when you look at smaller caps, that is where the struggle appears to be happening, in particular with respect to tariffs and input costs and the like. So I think one of the things that, again, kind of highlights why the AI theme is so important is not just that it's transformative on its own, and I think there's some building evidence there, but also that other parts of the economy are a little softer, and we see that in the data too.
What are the limits to bonds and stocks rallying together?
So I'd say a couple things there, and I think this goes to part of how some of the investors at BlackRock are thinking about it. There's not just the impulse that we're seeing from the macroeconomy, from technology, but also some of the pricing dynamics as well. I think that you look at some of our macro investors, they're saying, yeah, this is a constructive backdrop for risk, but there's been a pretty big run up too. We might want to pull some chips off the table, even while maintaining constructiveness over that 6, 9, 12-month horizon today. And on the fixed income side, I think we've seen the U.S. rally versus other global bond markets. I think there too, kind of looking out over the next few months, a bit of an expectation that we could see something of a reversal, at least on a relative basis. See U.S. bonds underperform a bit as we see European bonds in particular poised to outperform.
Well, I guess that to build on that, there's this question of the idea that bonds and stocks are rallying, but the dollar isn't participating in it. And it raises this sort of conundrum. Is that the release valve? That this is an economy being run too hot, where there are questions around the independence of the long end of the yield curve. And essentially, if you're going to bet on bonds and stocks rallying together and you bet on a weaker dollar, this doesn't have to do with something that is sustainable. It has to do with a policy that is currently concentrated on running things incredibly hot. I mean, at what point is that the correct way to look at things?
Yeah, so I think that we see that divergence between equities and the dollar as one of the key dynamics of 2025. And a way of squaring the circle is to say, as we've been talking about here, the equity story is really about large caps, is really about the AI transformation. That is what is driving that story kind of above and beyond any macroeconomic dynamics in the United States. I think the dollar, that is a more traditional macro story. concerns around the fiscal outlook, concerns around inflation that may be stickier out over next year than is currently anticipated, concerns around global allocators wanting to increase the degree to which they're hedging against the dollar. Those are dynamics that I think are, importantly driving this different response in equities versus the dollar. But I think you're right. The dollar is where you see the more traditional macro dynamics playing out than in equities, which is really, about this much different impulse around technology.
It feels idiosyncratic with equities to AI, and then everything else is driven potentially by a little bit of uncertainty in Washington, like the dollar. If you're looking for a hedge, isn't it just gold, or is there other opportunities out there?
Well, I think this is something we've talked about before. I mean, it is clear that gold has run up. It is clear, I think, to us that reflects investor demand for alternative sources of diversification in a world where the traditional sources don't look as reliable, like long-dated government bonds. I mean, I think this is where, we think that, things like market neutral strategies, things like uncorrelated strategies that can bring alpha into the portfolio are able to meet that same demand for alternative sources of diversification, but in a way that we think is more kind of underpinned by a reliable source of alpha looking ahead.
One thing you've talked about is regaining leadership, which suggests it was lost. And this year, what we've seen is European banks absolutely rip. So when you say something like we'll regain leadership, what does that mean for the European stock trade that's had its moment in the sun?
I mean, I think if you look at, that's correct about European banks. If you take a step back and look at the broad indices, Europe and the United States, what you basically saw was a moment of European outperformance in the first quarter of the year. And then really from the nadir in U.S. equity markets on or about April 7th, the U.S. has regained leadership and has really been the place where we've seen outperformance since early spring. Now, the one thing I would say, and I think this goes back to the dollar point, yes, the S&P is up 13% on the year, is up over 35% since April 7th. But the experience of being an investor in U.S. equities for a European investor, for a global investor, given that dollar move, has been a more uncomfortable one if you're unhedged. And I think this is why one of the things we're hearing from global clients is, boy, the past couple of years, I've been willing to take that currency exposure on an unhedged basis, that I've been comprehensively bought into the U.S. exceptionalism trade. Now I want what U.S. equities can offer in terms of technology, in terms of AI, but I'm a bit more cautious on the currency, and I want to move back to something like my traditional degree of hedging to balance those risks a bit better.
That's a bit of change. Mike, it's good to see you, to get an update.
Great
Thank you, sir. Mike Pyle there of BlackRock. Amazing to hear those words, isn't it? That we regained leadership 5 days after April 2nd. It's kind of crazy, right? 5 days after April 2nd, U.S. equity markets started to regain leadership.
This goes back to the idea of what Vito was talking about earlier from RBC. Do you just put on noise-canceling headphones and ignore the noise? Well, yeah, because ultimately that's worked every single time, and this is a primary example.
It's paid off over the last 6 months, that's for sure. Up next, David Stubbs of Alphacore, Ben Kallo of Baird, Nela Richardson of ADP, Binky Chadha of Deutsche Bank. From New York City, the third hour of Bloomberg Surveillance is up next.
This isn't a thing where it's going to be a long-term shutdown.
Trump is playing a different game by a different set of rules than I think the Democrats on Capitol Hill.
The market doesn't seem to really be paying attention to what's happening from, the government shutdown perspective. The data is the data, whether it comes out or not.
This means we're flying blind in a highly foggy environment, and this is very risky.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Stay in bed. No jobless claims. No payrolls. Live from New York City this morning. What will we do? Good morning to you all. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. What will we do? Keep buying stocks. Up by 0.2% on the S&P. Following 4 days of gains, we add some weight to the rally. All-time highs for October and the start of Q4. In the bond market, a 2-year closer now to 350, 355. We're up a basis point today, but down a handful yesterday following a downside surprise on ADP and a not great ISM manufacturing. As for the rest of this week, it's going to be about ISM services. There is a big question mark around the payrolls report tomorrow, and I believe we have confirmation we will not get jobless claims in 29 minutes' time.
Yeah, and it's really unclear exactly how long it's going to take once the government does reopen before we get some of these data. So if you take that into consideration, you understand why ADP yesterday, usually a peripheral data point, had such an outsized move where the 2-year yield went down the most going back to when we got that non-farm payrolls report that was disappointing in August. Right now, though, and I think this is the key point, and it's the key point for why people keep buying stocks, there is a rate cut completely priced into the market later this month, and there is another one almost completely priced in at the end of this year. So right now, it seems like the Fed's getting a huge green light by the markets to keep on cutting.
Exuberance on Wall Street. Misery and chaos down in Washington, D.C. The president saying this just moments ago. I can't believe the radical left Democrats gave me this unprecedented opportunity. They are not stupid people, so maybe this is their way of wanting to quietly and quickly make America great again.
So he's talking about when it comes to the layoffs and this potential to make them permanent. The president even questions in this Truth Social that he's working on whether or not these are going to be temporary or permanent when he meets with Russ Vought, the OMB director, today. This makes me think that that threat, was it just a threat to get Democrats to the table, or actually is this the Trump administration using this moment to shrink the federal workforce, which is something that they have been wanting to do?
The Federal Reserve believes this labour market is fragile. Those kind of developments aren't going to dismiss those fears.
No, especially in the Washington, D.C. region, if there are more layoffs, and then potentially what that means for some of the state and local governments, especially if there are fundings, there is funding that is brought back. Earlier this morning, we were talking about Polymarket and what the market is pricing in terms of how long this shutdown is going to go on. Right now, there is a 35% chance priced in that it will extend longer than October 15th. At that point, there starts to be some economic blowback, and then we're going to have some really serious conversations.
Economic blowback. Individuals don't get paid. Most importantly, the men and women in our armed services, the military, that pay date is supposed to be October 15th. And then potentially this is when you get a lot of pushback from constituents calling up their lawmakers and saying, reopen the government. This has gone too much, especially the grumpy travelers when you have issues at the FAA.
They're going to be getting grumpier, that's for sure. If you're just joining the programme, welcome. Equities up again this morning by 0.2%, a marginal lift to this stock market. Going into the opening bell about 87 minutes away. Coming up on the programme, David Stubbs of Alphacore as stocks trade near all-time highs. Ben Kallo of Baird with Tesla set to report 3Q delivery numbers. And Nela Richardson of ADP following weaker than expected jobs data. We begin this hour with stocks kicking off October at record highs. David Stubbs of Alphacore writing, I'm watching out for the peak of the AI boom. If AI hype ends, then volatility would increase before an eventual peak. David joins us now for more. David, good morning. Good to see you, buddy.
Good to see you.
Let's get into it. AI, any sign of that boom? Anytime soon?
Not really, no. I mean, I think you have to look for the signs ahead of time because we know how important it is, right? We know how important the AI theme since the launch of ChatGPT has been to earnings, to valuations, to capex. Is now driving, of course, the real estate sector, data centers, energy, etc. When you look and you compare it to other booms, and Azim Azar at Stanford has done tremendous work on this. Things look pretty good. Yes, it's driving like 1-2% of GDP. That's not outsized. If you look at the growth in revenue, and especially the funding sources up until this point, right? It's been funding out of cash flows, not too much debt. But around the edges, you can start to see that change a little bit, right? The disappointment around ChatGPT 5. Are we actually going to get this incredible technology, or is it going to disappoint? And then the Oracle announcement, very, very interesting, right? Stock jumped, and then that announcement of you're going to do a huge amount of debt to fund it. So if you start to see the sources of funding shift from cash to debt, if you start to see disappointment in delivery and a lack of revenue growth, that's when I think the key names are going to get volatile. That could be the sign of a peak. I have no idea if that's going to happen tomorrow or if that's going to happen a couple of years. I think it's probably a couple of years away, to be honest, but we've got to look at it for risk management purposes.
So in the meantime, the boom continues, and at the moment it's not driving a significant lift in employment. Is that de-emphasising traditional indicators for markets?
I think the previous guests in the last hour have done a great job of discussing this very unusual moment we're at in macro, and it's hard enough before the data was cancelled, right? So you've obviously got the capex really being quite strong, and obviously job growth slowing. I think one thing to point out about the labour market, earned income's actually been pretty strong this year, right? Which is jobs times hours times earnings. That's been going along at about 5% annualized in the first half of this year. Pretty good this quarter. I do think that capex can only take us so far. consumers have the ability to smooth through a quarter or two of lackluster job growth, right? They've got plenty of embedded wealth gains. Credit markets are wide open. But eventually, could we grow with zero jobs forever? Probably not. So I think that remains the key macro risk, and ultimately it'll be a macro risk which undermines the market's faith in the earnings trajectory at some point.
A lot of macro models try to follow history, right? And they try to understand how this relates to recent history and beyond. And one of the problems with this moment is it feels transformative. And as though maybe it's a corollary to, is it the dot-com bubble? Is it 1971? Is it 1944 when there were some really transformative mechanisms to the whole trade system? What's your corollary right now?
It's tough to find a specific historical corollary, but you can definitely look back at that launch of ChatGPT and say it was almost a structural break in the market's understanding of the future of the economy and productivity. Certainly, the AI's ability to, in theory, not just improve the productivity of manufactured goods, etc., but also to reach deep into the white-collar space, I think is different this time. And when we look at the labor market, there's been lots of very detailed studies pointing out that you can already see it in the lack of hiring of junior positions, especially in large companies, right? They're thinking, well, I don't have AI perfect now, but I know it's coming. Why do I need another generation of analysts? So there's been, by some measures, you're seeing a decline of 10 to 15% in hiring of juniors, and actually a little bit of an increase in mid-tier staff who've had that experience. Companies really value that. So I think we are seeing, the leading edge of AI in large companies hiring and in their margins, and you're seeing it spread out way out of tech. Great way to play this, of course, is the financials. Financials have two things that makes AI really work. Firstly, they have a bunch of basic costs that they can obviously automate away, back office, regular processes, and they have massive amount of proprietary confidential data, which they can use to offer better services to their clients. And I think that's why you see this idea that that financials could be trading a little bit more like technology stocks. Jamie Dimon's always said, I'm actually running a technology company. I think AI is actually going to make that real when it comes to their margins and their earnings.
Everyone wants to be a technology company right now.
Yeah, do you remember that?
I mean, honestly.
That was when they were struggling to hire talent.
Exactly.
It was like, we're a tech firm too.
Exactly. I mean,
no, you're not.
Well, they're trying to make the pitch again. I'm just wondering, we've always said the stock market's not the economy. Has it ever been more so than right now? And does that mean that the correlation between bonds and stocks just completely breaks down? Just, they're dancing to their own music.
I think when you have this transformative trend that's really playing out in the largest companies in the world that are based in America, you have then, of course, the weakness of the dollar in the first half boosting the earnings of the international larger companies there. That's obviously reinforcing that point about it not being the stock market's not being the economy, right? So I think that you do have at some point a linkage between the two, but right now we have the high-end consumer driving what consumer spending there is. The percentage of spending from that top cohort just grows and grows. The wealth of that cohort just grows and grows. And unless you get some type of clear interruption from a major macro decline, I don't see what would interrupt that.
When you think of clear interruptions, the president is truthing this morning that he's unsure yet whether or not he's going to make these, what should be furloughs in the past, usually, permanent layoffs. What kind of impact could that have?
Well, it's certainly unfortunate timing given how weak the private sector hiring has been, for sure. Again, I don't know, you'll know better than me, like how much of this is bluster, how much of this is a political game. I think that widespread layoffs will be popular in some parts of the country and very unpopular in others. I do think that this is part of the political posturing here, trying to blame both sides. We've been through these before. What worries me is that both sides are quite dug in here. There have been very clear asks from one side, which is very hard to deliver for the other. If I'm guessing, I do think we're going to be at this for a few weeks here.
Longer than October 15th, what we have on Polymarket? Maybe you should make a bet.
Well, yeah, I'm not going to give out betting advice on TV, but I think it's going to be weeks, not days, is my sense, but who knows?
That's wise, David. Let's finish on managing risk, and more specifically, concentration risk. I think people might be looking at other asset classes, other sectors within stock markets, and trying to diversify, but ending up in the same trade. AI, you mentioned financials. There are some financials that ultimately are giving people exposure to the same thing. I can think of some private asset managers getting exposure to private markets, but in the same thing. Are you worried about concentration risk, and how are you and the team managing that?
We are looking through all of our investments. In Alphacore, we specialize in putting private investments and alternatives at the center of portfolios. If you work with your GPs to understand the themes that are driving those things, how they're invested, match those up as best you can with the public markets, you try to get at this kind of thematic concentration risk. And right now, it's very hard to avoid. Right? Good luck trying to find a high conviction play that's not AI related. I can think of a couple, but they are more niche. We talked about European banks in the previous segment, the broad releveraging of the European economy, the defense play outside of the US, the rebound in China tech. But again, it's China tech AI. So I think you do have to, you absolutely, that's part of what good money management is. Try to find the risks, try to hedge them a little bit. It's very hard to move away from it right now. We're still, again, we are believers in AI in the medium term. We are still staying long that large cap growth space. But we are trying to find with our managers other key themes to drive the next 5 to 10 years. They're out there, but separating them from the AI, that's quite hard to do.
Pursuing that concentration has been the objective, at least for the moment, because it's working. And it's been working so well.
It's been the reason for U.S. exceptionalism in the equity markets. I'm just trying to research the biggest busts in the dot-com era to understand what the corollaries could be there. Because ultimately, you raise a really good point. Everything is concentrated around the same theme, or a lot of the winners are. So how do you decipher which are barking up the wrong tree?
David, good to see you. Thanks for dropping by.
Pleasure.
Thank you, sir. David Stubbs there of Alphacore. Let's get you an update on stories elsewhere with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Apple is pausing a planned overhaul of its Vision Pro headset to focus on developing smart glasses. It's working on at least 2 types, including one that will pair with an iPhone and another that could rival Meta's Ray-Ban display. Apple's glasses will rely heavily on voice interaction and artificial intelligence. The race to succeed Bob Iger at Disney is heating up. A growing consensus among company insiders suggests Josh D'Amaro will be the next CEO. D'Amaro, who currently leads the Parks division, is reportedly one of 4 internal candidates the board is focused on. The others include entertainment co-heads Dana Walden and Alan Bergman, as well as ESPN chief Jimmy Pitaro. Bob Iger's contract ends in December of 2026. The Los Angeles Dodgers are the first team to advance in the MLB wildcard round, sweeping the Cincinnati Reds. Elsewhere, the New York Yankees have forced a decisive Game 3 against the Boston Red Sox after winning last night 4-3. The Padres and Guardians also fended off elimination. That sets up just the second time in baseball history there will be 3 winner-take-all playoff games in one day. And that is your Bloomberg Brief. John.
Bonnie, thank you. Appreciate it. Seem happy with yourself?
I am happy. I'm
Good.
so excited. Jazz Chisholm had an amazing game after being
Bramo,
the day
stare
before.
at you right now. I mean,
that really,
when the camera picked you up, that was so much kinder. Because the one, you're quick. That expression changed. The one you were giving Marie before.
She's just wallowing in her mess.
If looks could kill. Up next, let's get you some morning calls. Plus, Ben Kallo of Baird with Tesla set to report 3Q delivery numbers. That's coming up in just a moment. Live from New York City this morning. Good morning.
If we just go back to as recently as the tech bubble, things were practically primitive versus where we are today. This isn't the primitive stage of people saying someday we will have 1 million eyeballs on our website. This is companies that know you need billions of eyeballs and you need to be well capitalized.
It's real money. That's why it's so hard to fight. And that's why this market's performed so well, despite what we've seen in the labour market. John Stoltzfus there of Oppenheimer. This is what we see in the labour market this morning. Not going to see it. 15 minutes away. No jobless claims. You thought it was an accident, didn't you?
Crickets. Yeah, I did.
Okay.
I thought you were going to get really
TV,
upset.
magic.
Okay, I know, that was
Just,
amazing.
Theatre
it was good.
performance.
It was good. I didn't even say anything.
Okay, all right.
Call me out for something I didn't even say.
Silence didn't work. Okay. Equities are up by 1/3 on the S&P, on the Nasdaq up by 0.5. Let's get you some morning calls. First up, KeyBank upgrading Nike to overweight, highlighting comfort in the company's turnaround story. Your second call from Canaccord, downgrading Lithium Americas to sell, saying its current valuation does not accurately reflect its deal with the US Energy Department. And finally, William Blair downgrading RH to market perform, warning US furniture tariffs may create challenges next year. Their stock is down 1%. They have had a tough go of it, RH, and that's going to make it harder.
Yeah, they said, look, you cannot raise prices. People won't buy it at the same time the prices are being raised. And I just want to say, you usually are so smooth, which is the reason why I was a little bit stymied in my
I said
reaction.
crickets. I understood
So
what he was putting down.
I know, but
I was expecting you to hit one of your noise machine buttons.
You know?
Yeah.
Okay, all right, we'll move on. Thanks for the smooth compliment.
I failed.
You're being nice. I appreciate it.
Live
I'll
TV.
run with that. All right, let's turn to tech. Tesla releasing third quarter deliveries this morning with analysts predicting a slowing sales decline. Ed Ludlow's tracking the company. He joins us now. Ed, what can we expect?
Yeah, I mean, consensus is that Tesla does just shy of 440,000 vehicles. That's a 5% drop year on year, but it's an improvement sequentially from the balance of 2025. You said turning to tech. Are we turning to tech? This is just a moment in time where we're talking about the delivery of vehicles. And what I keep hearing from sources over and over again is look at the work that inside Tesla was done on advertising, paid advertising on platforms like YouTube and Instagram in the quarter, and also all of the marketing materials that went out about the end of the federal tax credit. So there's that typical scramble. But the reason I bring up the advertising piece is this is the delivery print before that critical November 6th vote on Elon Musk's comp package. He's been set the target by the board of delivering 20 million vehicles, the bread and butter business, by the end of the term and the full fulfillment of the tranches that he's to receive. It's conditional, right? It is a mandatory requirement. But a lot of the investor base, even those most loyal to Elon Musk on the retail side, have been calling for Tesla to do some advertising, some marketing, something that Musk has resisted for a long time. So that's what I'm hearing from people inside the company. They're kind of feeling that something changed in the quarter, but with a firm eye that there's a lot of pressure to get this vote through November 6th. And just this week, we heard from New York State Pension, right, that they will not be voting in favor of it. It's a really critical moment. The data informs more the long term than potentially what's happening in here and now. But broadly, the EV market in the US, as you know, John, there are some cracks showing.
The stock is up by 1.9% this morning. Ed, thank you. Looking forward to Bloomberg Technology. Ed Ludlow, Caroline Hyde coming up a few hours from now. Ben Kallo of Baird recently upgrading Tesla to outperform, seeing a string of catalysts ahead. Ben joins us now for more. Ben, welcome to the program, sir. As you know, you often talk about it. There's always tension with this stock, near-term fundamentals versus long-term dreams. The question I always ask about these particular stocks, the likes of Tesla, is what is driving it right now? What makes it go up or down? Is it the long-term story or the near-term fundamentals?
Thank you for having me. Good question. I think right now it's the long term. I do think that deliveries are going to be better than expected. We've seen analysts raise their numbers, and we've seen good data out of China, U.S. ahead of the tax credit, and in Europe. But I do really think that with OpenAI getting this $500 billion valuation, the real focus here is on physical AI. I think that the shareholder meeting will be a catalyst. People want Elon to be at the helm. I think Tesla stock wouldn't work without Elon there. Ambitious targets, but we've seen over the last two pay packages. Back in the first one, arguably I was labeled one of the biggest bulls out there, a perma bull. When I saw the targets, I didn't think they could do them. They did it in 2 years. The second package, same thing. They did it in 5 years. I think this one maybe not as easy, but when you put the numbers together, you can get to a stock price of $1,500 or more. And I think that's where people are focused, less on the car business. The car business is needed to support growth because of the cash flow, but we've seen it rebound after really bad quarters over the last 3 quarters.
Ben, how is Tesla maintaining the cash flow from sales in China right now? How is Tesla even beginning to compete against the machine that is the EV creation coming out of the world's second biggest economy?
What we've seen so far is that they did this new Model Y variant, a long wheelbase. So far, the reception has been very good. Tesla competes very heavily there, and I don't think they had as much brand damage in China as in U.S. and definitely in Europe because of Elon and being the political spotlight. But the new Model Y at the beginning of the year, they shut down all their factories to ramp up the new Model Y, and then the lower price vehicle that should come by the end of the year. That was a big task, but what we're seeing now is uptake from as they get that production back going strong.
What's interesting to me, Ben, is that we're talking about this as though it's any other country, and yet a lot of U.S. companies have talked about how they're pulling out of China. They can't compete there. They're getting blacklisted there. They're not able to get the same kind of upper hand as some of the national champions. I would think that Tesla would be first and foremost among those companies that would be facing some of those pressures. Why don't we hear anything about that, given how much Tesla relies on their China sales?
Just bringing it back to Elon, for right or wrong, there's all these headlines hitting that, his net worth is $500 billion, and then the pay package would make him the first trillionaire. I remember Elon, unexpectedly went and had a meeting with President Xi. He has that type of power as someone that, has a net worth of $500 billion. He can go meet with the heads of state across the globe. And I think it's different than, the OEMs like Ford and GM and some of the Euro OEMs as well.
Well, he can meet with heads of state across the world, but is he still invited into the Oval Office? How damaging is that for the company?
Well, it was very damaging from a stock perspective when you get into a spat, to say the least, with the President of the United States. I think that we've seen them try to make up. I think that he is doing his best to do that, and that has helped the stock as he's tried to repair that relationship.
Hey, Ben, appreciate your time as always. Ben Kallo there of Baird, the latest with Tesla. They sat together recently, didn't they?
They did.
Had a little conversation, broke the ice.
Had a conversation, broke the ice, but you don't see Elon Musk once again as this pervasive presence at the White House. Not only did he get a spat with the President of the United States, but there are reports that the President of the United States Treasury Secretary actually punched him. So this is bad blood at the moment.
Policy didn't break his way, didn't break the sector's way when it came to the EV tax credits. I just got a question moments ago about how much pull forward there might have been ahead of the expiry of those. I've heard from several people that have come on this program and spoke to us in a commercial break about buying EVs before that ended.
Yeah, so at a certain point, they could benefit from that. Maybe we get a sense of that later today. I'm just struck by this idea that the richer somebody is, and I'm thinking of Jensen Huang, I'm thinking of Elon Musk, I'm thinking about some of these magnates that are leading some of these technological drives, the more they can act independently as their own little diplomats and sort of go meet with the heads of state themselves. That, to me, is a game changer. It really reflects the sort of dual paths of a lot of these companies.
They are as big as their own countries, right?
Bigger.
So why wouldn't they have their own diplomatic wing?
But that's essentially the reason why the bigger you are, perhaps the more you have some degree of immunity from some of the policy uncertainty.
Where are we now? 4.5?
Yeah.
Trillion?
$1 trillion. T. And we could have a trillionaire and Elon Musk. I mean, who's next?
Amazing. Futures positive by 0.3 up next. Nela Richardson of ADP. We've got to get into that ADP number of the last 24 hours, the lowest in a few years from New York City. This is Bloomberg. Equities a little firmer, up 0.25% on the S&P. The opening bell about 60 minutes away. This follows a 4-day winning streak. It could become day 5. Typically, we'd say it's at the mercy of the data, but we don't have any. Mike McKee joins us now for more. Good morning, Mike.
Oh, John, that's not exactly correct. I wouldn't want to leave you with nothing at this point. What's the first thing you might do after hearing that you've lost your job? You want to check out what your health insurance possibilities are. And the Labor Department has a website that explains how COBRA works, and they keep track of how many people have accessed that website each week. Last week, 245,000, which is a spike up from the previous 2 weeks. So it may be a kind of a little bit of a psychological substitute here for the jobless claims numbers. People are worried about whether they can keep their health insurance if they're laid off. This does not include all the government workers who left the payroll this week, but because they don't get COBRA, but it is something interesting. What else do we know about the labor market going into tomorrow's no jobs report data? Well, we know that the Challenger numbers came out this morning, and they showed the weakest September for hiring since 2011. JOLTS hiring in July was down 2%. Layoffs were up 9%. Conference Board job confidence, the lowest since 2021. ISM manufacturing hiring has been below 50 since January, the break-even period. And of course, we had the ADP numbers yesterday that showed a very disappointing negative 32,000 jobs. But I know you're going to be talking about that with Nela Richardson in just a moment, so I'll leave that one alone. The one thing I do want to point out for everybody out there who has a Bloomberg terminal, we have an alternative page. It's WSL ALTE, and it's a list of economic data that is privately provided that will be available on a regular basis. So if you want to look at alternative data, look at that WSL ALTE. Go on your Bloomberg terminal.
Mike McKee, thank you, sir. Only you could come up with this stuff. Appreciate it. Thank you very much. Thank you. He's not going to be alone, is he? A lot of people are going to look for new ways to track what's happening in this economy.
Never underestimate the ingenuity of Wall Street to find something to trade on. And that, I think, is what we keep learning and what we see this morning with talking about Cobra applications and the amount of traffic on that website.
Well, something to bet on.
Yes, exactly.
Which is a different story. Nela Richardson of ADP joins us now for more, following the lowest ADP we've seen, I believe, since March 2023. Nela, good to see you.
Great to see you as well.
What was behind it? How much weakness are we actually seeing?
First off, I think it's important to underline the prominent trend in the ADP data, which is a slowdown in hiring momentum that's been from January through this year. That has been consistently validated every single month. What we did this month, though, was a statistical regularity. We do it every year. We announce it in February with the January release, which is to do an annual benchmarking. Normally, this does not make news. This month it did, but what it does is it reattaches the ADP numbers to the source of truth that we have in the United States, which is this benchmark that comes from state unemployment insurance data, this kind of data that we see weekly with the jobless claims numbers. And the importance of that is, if you really want the perfect data set, you would have the comprehensiveness of the state UI data covering 95% of U.S. employees and the granularity of ADP data. We don't have that. So we make this trade-off of ADP estimating that state data that comes out with a 6-month lag. We reattach to it every single year.
So was it as bad as it looked yesterday? I mean, that's really what people want to know. This all sounds very complicated, and it sounds like, there are a lot of things at play. But the granular data, does it display the same kind of negativity that the bond market took notice of yesterday?
Yeah. It does. This is our best estimate of what hiring was in September, negative 32,000. That is our best estimate. It is our most robust estimate. It's rigorous. It's tied to the QCEW. So, no, you don't need to dismiss the number. Now, if you look at the series, we don't fully re-benchmark the year until February with the January release. But that September number is the number. So what it tells you, even if you look at the pre-benchmarked series, which I did, of course, you see the same trend. And this is what I want to underscore to your audience, because the takeaway is qualitative and the takeaway is firm, validated, that hiring momentum has slowed since the beginning of the year to a point where it is a weak labor market in terms of hiring. It is not a weak labor market in terms of layoffs. Very important to hold these two ideas together. The stock of the labor market is strong. The flow into the labor market is weak. The flow out of the labor market is weak.
So is the market breaking, or is it just an ongoing stagnation of the low fire, low hire that still has not broken in one way or another?
We have a stagnant labor market. And all of that consumer spending that fueled Q2, a 3.8% growth rate we just saw, was built on the backs of the labor market, because the labor market is supporting the consumer. So in that way, it's strength. But that strength is not strong enough in terms of consumer spending to create new jobs. That's a different level of economic productivity that we still need to see in the economy that's missing the dynamism that leads to consistent job creation. We don't have it in the September number.
This time tomorrow, we would be debating and looking at the data when it comes to the BLS report. We're not going to get it. What do you make of the shutdown? How much of an impact is this going to have on the economy?
It depends on how long the government stays shut. But what I will say is that the shutdown doesn't just affect federal workers. It does affect federal workers, but not just. If you think about all those private contract workers, the ones that operate the cafeterias, the ones in the national parks, the ones that drive government officials here and there, they are also without work as the government shuts down. So it's these reciprocal effects that I'll be watching in the private sector data to see if this leads to even more weakness in hiring because of all those private contractors.
In the past, did you see it bleed into the private sector?
Yeah, but it was always temporary. We know that the longest shutdown that we've seen recently was 35 days. That's a long time to be without a paycheck. I don't care who you are. It's a long time to be without a paycheck. And so that is going to have an effect in the labor market. It's going to have an effect in consumer spending. But if we can get a reopening that's much shorter than that, we won't see such a strong pushback in the labor market when it comes to hiring. I also will note that this just adds to the malaise of uncertainty that we've seen all year long. It's not just the data, it's not just the conditions, it's the fact that, companies are going to operate through fog. If you're a private contractor, do you hire right now? And how much do you hire? That's the question before them as the government is shut.
The entire morning we've been talking to people who say that the U.S. economy can keep running at this very slow pace, and we can still see the incredible dynamism that's reflected in equity market pricing. Do you see the same relationship, or do you think that there is a greater warning flag in the labor market and the dynamic that you're seeing there for the other side of the equation?
I feel like we are at this traffic light right now that is out. You know what happens to traffic when the light is out, right? You fall back on this, you take your turn, I'll take my turn. Sometimes we get that confused and we go at the same time. And once we're past the light, we're fine. That's where we are in the economy. We don't have the data we're used to seeing. There's some uncertainty about who goes next. We won't get the flow. There's bottlenecks. That's what gums up economic activity. But if you can get past that into some clarity, we have all the ingredients in this economy to push forward with strong GDP growth, as we saw in the second quarter. So some of this is just getting the lights literally back on and the data still flowing so we can keep that dynamism flowing.
That's the data. But when it comes to hiring plans, if there is a greater degree of mergers and acquisitions and certainty, at least from the economic trajectory, maybe not in the tariffs, do you expect the hiring to reaccelerate? Do you think this is going to break to the upside rather than further to the downside?
I think there's a potential, but right now it is not clear where that trigger of dynamism comes from. For employers to hire, what do they need? They need clarity, they need strong consumer demand, and they need the ability to invest long term. So they have some of those elements in place. I think we're still missing the clarity, and that's a really important component of whether or not you can add to your headcount, which is a long-term people investment. Now, one thing I'm hearing employers say is now if we can't hire our workforce, let's make sure the workers we have are more engaged. And when I talk to the big companies especially, there has been more attention on how to upskill their workers, train their workers, engage their workers, have more connection to get the most out of the people they have right now, even if they can't add to the headcount in a significant way.
Keep your people happy. That's what it's all about. I'm pleased we're getting back to that. That's good.
Yeah, did you hear keep your people happy?
More
I
of
heard
that.
Get more out of them and milk them for all you can. You can say keep them happy, whichever way you do it.
Happy people are more productive.
There you go.
There, yeah.
Nela, thank you.
Snacks.
Appreciate it.
That's
Nela
good.
Richardson there of ADP. Typically, we'd get jobless claims. We didn't. 225 was the estimate. 218 was the previous number. The 4-week average has been around 237, 238. Those numbers are pretty low, despite the fact we've had this massive step down in payrolls growth.
This is the whole idea of stagnation. You're not getting the firing, which raises the question, we've been in this place for a long time. Is it going to break one way or another, or are we turning into Europe?
Companies are investing a lot of money, but the companies that are doing that aren't the ones hiring. That's the problem.
Well, this is the reason why it's so difficult. And Annmarie, you were talking earlier about how much this is just AI replacement. There is an element of productivity being increased by some of this technology, which can prevent hiring, which makes me think in 3-4 years, the people coming into the labor market might have a really good chance because they haven't hired as much, and those people might be more conversant in AI. I might be selling a pitch for progeny who might be entering the workforce.
Of course, yeah. There's no bias here.
That's what I'm hoping for.
It's
anyway.
not about the Bramo family at all, is it?
This is literally what we're talking about, because right now it's making it very difficult for people who are graduating, other people in the family.
This is going to be a huge political issue. If AI is truly taking the jobs of young Americans coming out of college, where else are they to go? If you're not hiring entry level, how are they supposed to get on the ladder?
Which is why the H-1B visa issue of the past few weeks is so critical. It's a clear response to some of these issues. And I don't think that got enough airtime in the last 2 weeks. So that's going to be a major, major factor in all of this. That is a message to tech firms to say, look domestically first and hire American talent before you start looking abroad.
Yeah. Absolutely. That was part of it. The other political issue is going to, what we're already seeing is individuals lining up to get federal help to pay their electricity bills. AI is creating so many issues that the politicians are just way far behind on.
It's turning out to be regressive up front. And this is going to be an issue, I think, midterms.
You're right, next
Peter
year.
Cheer said it repeatedly from Academy. This isn't a multi-year story. This is a month-on-month story now. Those energy prices are real. That's going to be a factor next year.
Yeah, and how are they going to handle that? Which is the reason why I thought the Reuters story earlier was interesting. The idea that the government's going to try to take a stake in a number of different sectors, how they're going to try to get ahead of some of these issues for the midterms.
Let's get you an update on stories elsewhere. With your Bloomberg brief, let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. OpenAI's valuation soars to $500 billion. That makes it the world's most valuable startup. Sources telling us here at Bloomberg, current and former employees sold more than $6 billion worth of stock, pushing OpenAI past its previous $300 billion valuation. This all as negotiations are underway with Microsoft to convert OpenAI into a for-profit company. Arab and Muslim leaders are pushing Hamas to accept the 20-point peace Gaza plan announced by President Trump this week. Sources telling us here at Bloomberg, a full Israeli withdrawal is a significant achievement despite the timing not being explicit in the plan. Qatar's foreign minister said Hamas is preparing its response. Two Delta Airlines regional jets reportedly collided at low speed while taxiing at New York's LaGuardia Airport on Wednesday night. According to an ABC affiliate, no injuries have been reported. It's the latest in a string of incidents at LaGuardia in recent months that have prompted federal safety probes. And that is your Bloomberg brief. John.
Vonnie, thank you. Appreciate it. Up next on the programme, Binky Chadha at Deutsche Bank. He'll be joining us to talk about the equity market. Plus, Vonnie's back. She's got your morning movers, Tesla rising and Rivian falling, with the latest delivery figures out this morning.
The market wasn't quite sure what to make of those comments by Pyle, I think about a week ago. But I think it made it very clear that they are focused on employment risk relative to inflation risk. And if making the right call in their eyes on that macro risk management is associated with markets going up, that's all right by them.
That was Krishna Guha of Evercore RSI. He was absolutely fantastic, really laying out why people are so comfortable taking risk in this market and why so many of you, yes, many of you, are willing to chase further asset price inflation. And why not, given the year we've had so far? Equities at all-time highs, adding some weight to the rally, up 0.25% on the S&P, with some morning movers going into the opening bell 43 minutes away. Here's Vonnie with more. Hey, Vonnie.
Hey, John. Well, we're going to start with a whole industry overhaul. This right here is a fascinating story. So Fair Isaac, FICO, we all know it as, came out and said that it was going to start giving mortgage lenders the option to calculate and distribute FICO scores directly to consumers. Now, what does that do? Well, it disintermediates the like of Equifax and all of those other credit reporting companies. So think TransUnion and also Equifax, as I say, and Experian. So there were three of them, right? They're all down pre-market thanks to this decision by FICO. Investors repricing a whole industry today. Now let's move to autos, because that's also another industry very much in the bird's eye today. Rivian disappointing investors, even though it beat by a couple of hundred vehicles when it comes to deliveries. We know that the EV credit was expiring at the end of last month and there might have been a little demand pull forward, so perhaps that's why. the stock is down. Perhaps investors were looking for a little more, but it's a very niche company. We're talking about 13,201 deliveries in the quarter. The full year forecast, it narrowed that range, but that also met estimates. The estimates were 42,730, and there's a range in there. We are awaiting Tesla delivery figures as well. That's likely to please investors. That's why the stock is up pre-market. Sales numbers this morning should show just under 440,000 vehicles in the last 3 months. Now, that would be down 5% year over year, but would be a much better improvement over the first half of the year, where we saw sales down 13%. And of course, Elon Musk is back and quote unquote refocused at the company as well, with lots of milestones for him to meet to get that huge pay package. So he'll want those deliveries to come in strong.
Bonnie, thank you. Thanks for the update. Tesla up by 1.3%. On credit scores, always surprised by the average credit score in this country, that it runs in the 700s. That's pretty good, you know.
Yeah, it's very difficult to get to
Pretty
that level.
decent credit score.
Maybe a lot of people just don't have credit. You're correct. It seems like it's an incredibly high one, but don't you have one that's...
I'm not going to share those things. I've got a
Okay.
state-by-state background, though. Just
You're
in front
just
of me.
gonna do background
do you want
checks for everyone
state-by-state?
else?
I've got one for you
Please.
now.
Okay.
What do you think is the highest? I've got it in front of me. I think it's Minnesota at 730.
That makes sense.
Right? Why does that make sense?
I mean, I've lived out in that region before, and there just is a very
They check
strong
their credit all
kind
the
of-
time?
Well, there's just a very strong kind of pull your pants up by your bootstraps and,
Okay.
you know, that kind of thing.
Mississippi, 675. I think that's the lowest. I'm just eyeballing this data right now.
Let's not come up
It
with
comes from Equifax. I'll send it over to you. You can have a look.
I
It's an
appreciate
interesting read. All right. Sticking with markets, Binky Chadha at Deutsche Bank is one of the most bullish on the street with a year-end target of 7K. He writes, in our reading, however, equity positioning is only moderately overweight, and we see growth, not rate, as the primary driver to focus on. Binky joins us now for more. Binky, good morning.
Good morning.
Let's get into this. A lot of people would look at this market and say, well, everyone must be very, very long and overweight. What do you read? What are you looking at that tells you something different?
So overall, equity market positioning in our reading is clearly overweight. So if you think about it on a Z-score basis, normally we are in a range between -1 and +1. Our read in round numbers would be that the market's positioned basically at +0.5 or 0.5. So clearly overweight, but not extreme. But the related point that I would make is that that overweight is coming in our reading entirely from the positioning of systematic strategies. So if you think back to April there's April the 2nd, which is the lead in to April the 9th. And you have had basically on April the 2nd, what I would describe really as a vol shock. So you have the VIX in the 50s,
right,
and then you have the relent on policies on April the 9th, and vol starts to basically come down. You get a strong recovery, and so the trend and vol basically coming down is pushing up by rules the positioning of systematic strategies. I would say the much larger part of the investor base, discretionary investors, as opposed to systematic investors, and discretionary investors you want to think about as basically fundamentals-based investors, their positioning is basically at neutral by early July, and in our reading continues basically to hug neutral. So I would argue that actually positioning today, despite the run-up in the market, is a source of upside. Because if you look at the positioning of discretionary investors and what drives it historically, it's exactly what you would think it is, which is earnings growth. And so if you look at the relationship between discretionary investor positioning historically and S&P 500 earnings growth, it's a pretty compelling relationship. There are, of course, disconnects from time to time when other things are in focus. And if you look at their neutral positioning today, it's positioned for growth in the very low single digits, 1%, 2%, 3%. It moves around. And their positioning, like I said, has been this way since July. That's when we were getting second quarter earnings, which came in at 10% year-on-year growth, 9.5%. And if you think about what we're going to start getting in a couple of weeks, our take or preview would be that we're likely to get, actually somewhat of a pickup in growth, in earnings growth, closer to sort of 11%. And so the pressure is on, I would argue, for discretionary investors to buy in basically to this recovery where they haven't. They've really been focused on the risks, is what we would argue.
So this is a reason why you upgraded your target for the S&P for year-end to 7,000. That was earlier in September. I'm just wondering how much you see that continuing through 2026 to lead to some of the real bull cases that we've heard of 77, 7,800 on the S&P 500.
Yeah, so, our target for this year-end is 7,000. And the way I would put it is, actually, it's a reinstating of our target at the beginning of the year. We cut our numbers, our earnings numbers, and our market view. We remain sort of constructive that we would get a relent on policies and we would go a lot higher. But at the end of the day, I mean, I think the simple fact is, and as some of the guests earlier were saying, basically, you just don't see a lot of stuff in the data. I mean, if you think about, the reason for cutting was the tariffs, and they look to be having, a much more modest impact than we basically thought. If I look at earnings, so you start with macro growth. We got the second quarter recovery. You could say that 3.8% is partly a recovery from, slowdown in Q1. But we're in Q3 now, and the Atlanta Fed at last read was pretty close to 4%. So on macro growth, not much is showing up. And I would actually argue that a lot of the negativity and sort of the macro consensus that we would get, pretty significant slowing, that's a positive catalyst, and it's a mini version really of what happened in 2023 when the macro consensus, persistently looked basically for a recession that didn't come, and so what you got is basically 15 months of positive macro data surprises, and markets are not necessarily going to go down when you're getting continuously positive surprises. We're having a mini version of the same thing. If you look at the Citigroup data surprise index, kind of went vertical late last week. And so, discretionary investor positioning is exactly actually in line with the macro consensus of a slowdown in growth and a slowdown in earnings growth, but we're not getting those things.
Torsten Slock of Apollo made a similar point in the last 24 hours. Torsten was like, we all need to take a long, hard look at ourselves. We're waiting for the consequence of something that took place 6 months ago, and it's not happening. And he thinks that the risks are to the upside, particularly for inflation into next year.
Well, this is the key question. Have stock markets really not really appreciated the gains that we've seen in the economic growth trajectory? Or are we just talking about the bond market, which actually is recognizing weakness that the Fed's going to respond to?
If this isn't a sign of appreciation, what is it, Brad? All-time highs, come on.
Exactly. This is full appreciation. I think people are really appreciative.
Binky Chadha at Deutsche Bank. Binky, always good to see you, sir. Going into the opening bout, 34 minutes away. Coming up tomorrow, Chris Strategas, Priya Misra of JP Morgan, Francis Donald of RBC, Nadia Lovell of UBS.